Day, April 1st, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan as we take you through the rest of the trading day. Futures market closes at 5 Eastern, 4 Central. If you're already on the platform, if you're already on tastylive.com, thanks for joining us. Hope you continue watching. Otherwise, head over to YouTube where we're also streaming. Join the chat there. Tell us what you think of these markets, what you think of this back and forth price action today. I'm not feeling too comfortable or cool under the collar here, guys. Feeling like there's not much edge heading into tomorrow's turn of events, but we'll see what you two think. Stocks ultimately do resolve themselves mostly higher. A day where we were dipping lower now. The S&P 500 closes up by 0.38%, 5675. You have your NASDAQ up by about 0.86%, 19,605. The Russell's flat. The Dow Jones is down by 0.05%. Bond yields are lower across the board. Metals perk up and then come in. We see a dollar ultimately sells off by the end of the session. Energy rather uninteresting. Dylan, jokes aside about making sense of bonds doing well in any environment here at the end of last call, you were alluding to an environment where it seems like there's a lot of chaos and confusion underlying everything. I was just saying here to you guys in the green room that I feel like I have the least amount of edge I've ever had in my trading and professional career, perhaps, going into tomorrow. Talk me off the ledge, Mr. Radigan. Why is everything going to be fine for tomorrow?
Well, I mean, I think it's not about, I don't know that I can do that. I think that you have to come to terms with the fact that America's leadership is the most unreliable and adversarial in modern history. And as a result, all assets on Earth are 10 to 20% less valuable. And so I think the easiest way to make peace with the situation is not to try to pick this or this or this or this. It's to understand that the economic value of everything on Earth has been compressed because the most valuable and most important counterparty on Earth has become unpredictable and unstable. And so then if you understand that everything is, 10 to 20% less valuable on Earth, and then, and all the charts show this. You can keep flipping charts. You'll see the same reality. The question becomes, okay, well, I guess there's two questions. One, are the tariffs tomorrow an April Fool's joke? And will there be a last second delay? Very easily could be. But at this point, even if there is a reprieve on the tariffs, it'll just validate that the American president is a psychopath nut job. So this even if you really
the key, really,
yeah. So even if you get relief in the, and the point is,
if the show continues, the show doesn't continue because a continuation of the show would be exactly what the problem is. The problem isn't the substance of the policy, which the markets could have generally known and did back to November. It's the implementation and the fog. Exactly.
And so the reason I say everything on Earth is worth 10 to 20% less is not based on whether or not the tariffs are announced tomorrow or not. Rather, it's that the road to getting here and the temperament of the counterparty has proven to be an unstable lunatic. And as a result, everything is less valuable. It's like if you're driving in a car and if everybody in the world is riding a bus and everybody on the bus knows that the driver of the bus is hammered on whiskey, then that bus is by definition more dangerous for everybody riding it. And as such, it has a higher aggregate risk profile, which is what the whole world has right now, more risk on Earth. As a result, less economic value, diminished economic expectations, et cetera, et cetera, et cetera.
Ilya, heading into tomorrow's Liberation Day, we find a market that had a slight risk-off tone overnight and sentiment improved over the course of the session. Gold touched a new all-time high. Yields moved lower. ZB was only up close to 119 at one point. ZN is closing at we'll say what down here. I think this is a closing high for the year in the notes as it is. Closing high for the year in the notes as well. You seem convinced as you were trying to explain at the end of last call. It almost feels like there's some narrative flexibility here for bonds right now. the tariffs are high, the tariffs are low. Growth is slowing either way in the short term.
That's it. At the end of the day, we're going to get a tariff announcement. It will be some kind of an announcement of something. I don't mean that facetiously. I mean that nobody actually knows. The president was asked whether he's finally settled on a plan. He said yes. That was it. Here's where the confusion is. If the tariffs are supposed to be reciprocal, how do you do that? Do you set up parallel regimes with different countries that mirror what they apply to us? And how absurd does that get? The Economist, for example, has an example of Colombia that puts a 70% tariff on coffee. We don't export coffee. Are we going to put a 70% tariff on coffee for U.S. exports to Colombia that are largely non-existent? Is this a rule that we need? Nobody knows. If we don't do specific one-for-one tariffs, are we going to do average tariffs? How do we calculate that? What about non-tariff barriers? The president said he wanted to mirror those back at the trading partners. How does that work? Nobody knows. So this is really confusing, and rightly so. And so business leaders have pulled back spending, and consumers aren't confident about what comes next. Understandably so. It's very difficult to make heads or tails on what any of this is. What we do know, though, is that some kind of tariffs are coming. Tariffs, we've heard from the Fed, are generally bad for growth and generally a boost to inflation, but the Fed is open-minded to the idea that the boost to inflation is a one-off adjustment, maybe. But whether it is or isn't, that's a question. We do know it's bad for growth. And so the one outlet here, no matter what the substance of this is and whether the stock market thinks it got its certainty or it didn't, is rate cuts. And that means higher bonds.
I mean, the other thing that's interesting, and I don't disagree, I think the higher bond play is the sort of the risk, the most conservative way to get a trading position on at this moment is that. But I'm sort of contemplating whether it's that there's a lot of headlines in Europe today about Brussels using a tariff sledgehammer against a large American technology companies and large American banks, and restricting or eliminating their access to the 450 million consumers in Europe. You also have Japan, South Korea, and China talking about a coordinated attack on all U.S. So whether it's Apple, whether it's Google, whether it's Tesla, whether it's Disney, whether it's J.P. Morgan, now you're going to see at least, I mean, who knows how much of this ever happens, quite honestly. But rhetorically, in terms of the rhetoric in Brussels, the rhetoric in Beijing, the rhetoric in Tokyo, the rhetoric in Seoul is, well, listen, we represent 1 billion consumers of American technology, American banks, American cars, American product, and we'll use a sledgehammer on you. And so now you're sort of in this rhetorical race to the bottom, which I would say the obvious trade is to buy the bond, because no matter what happens, it's bad for growth and it's bad for confidence, which is a good for lower rates, I guess, and as a result, good for higher bonds. But also, I still think there's some room to be, the madman's delight, to use a term of our own invention from the three of us last year, would be to get short the tariffs. That ultimately these tariffs will, even if they're announced, will not be implemented by virtue of the sort of mutually assured economic destruction that's being brought to the table at this point, whether it's the aggressive rhetoric from Europe against all big American technology companies and all big American financial services firms, or the coordinated response that is being defined right now in Asia between China, South Korea, and Japan in direct attack on all American products. It's hard to see how this is good for any business on earth. Full stop.
All of which is to say there will be a negative economic response, and that negative economic response will require rate cuts. That's
and a higher bond.
As far as I'm concerned, that's the only sense you can make of this so far. And the question for stocks will be, do you get a durable thing that is announced tomorrow that you could extrapolate? And then stocks might say, okay, well, it's bad, but this is something businesses could benchmark against for the next year, 2 years, 3 years, maybe even. Maybe we're finally done with this back and forth, and we can move on to extending the tax cuts from the first administration, the other big objectives to get done for the second half of this year before midterms next year. So the calculus here politically is you got to get this stuff done. The rush to end the wars in Russia and Ukraine, as well as the Israel-Hamas theater, sort of part of that story. You have to get all this bull in a china shop stuff done so you can do the taxes, so you can run in the midterms next year, loosely speaking. And so when you get this announcement, maybe you finally get clarity. And then everybody goes, okay, fine. This is awful or not awful, but whatever it is, it is. And now we can map out what we're going to do next. And markets settle because they find their new baseline. Or, as recent history would suggest, you don't get clarity. You get what we've all surmised are tariffs as a negotiating tactic, which means it's an opening bid that can be negotiated down. The president can change its mind. The trading partners can come back and say, okay, opening bid received, now let's negotiate. And now everybody has to wait for the negotiation to continue. More uncertainty. So if you don't get that, well, then stocks probably react negatively because, again, they don't know what's going on in 3 to 6 months, and neither do businesses and neither do consumers, which is obviously a dampening effect on all manner of economic activity. Then stocks don't like it. But either way, you're going to need rate cuts.
I mean, how about this? Globalism, or globalization, I won't say globalism, I guess that's more political. Economically, globalization of economic activity is being reduced. I won't get
very clearly so. Yes.
No question.
No question.
To the degree to which global economic activity, trade between China and America, America and Europe, Europe and America, Canada and America, America and South America, whatever it is all on the decline. Full stop.
And all of that on top of it is potentially inflationary depending on whether these barriers stick around. So there was an interesting timeline that came out that basically said either way the tariffs lead to disinflation, which is an interesting thing because on one hand that's true. If you crash the economy, inflation will go down. If you slow economic activity, inflation will be cooler. If you set up reciprocal tariffs and other countries say, you know what, rather than fight you, we're going to lower our tariffs, so you have to lower yours. And this is a kind of shadow WTO, a kind of way to say, instead of having the WTO, the U.S. will just create a parallel WTO, neuter the existing one, and say we're overtly in charge. There's no even pretense to this being a multilateral organization. This is a shadow WTO that we run. And everybody lowers their trade barriers in response. Maybe, fanciful, but maybe. And then there's disinflation then. But if tariffs remain, however benign or certain or whatever, that's inflationary for the longer haul, whether you have a recession near term or you don't.
I mean, I've seen a lot of people say, even, you know, even economists who are partial to the Trump tariffs. Oren Cass, who runs American Compass and has been making the rounds in media to support Trump. He was on the Daily Show last night with Jon Stewart. He said today, quote that came out, if you want auto companies to build more domestic plants, if you want steel companies to expand domestic production, they need to have some understanding of what the long-term outlook is for tariff policy. He continues, you get the costs and disruptions with tariffs without the upside of the investment otherwise. And that's kind of where we are right now, right? We have the disruptions and the costs of the tariffs. Lumber prices have moved. Steel prices have moved. We've seen that companies are beginning to steel producer in Cleveland just cut 1,200 workers because of the uptick in costs and now lack of demand for their goods. They just can't afford it. Can't keep the doors open, right? So the tariffs aren't necessarily there yet, but we've had all the costs and disruptions start to be levied. But we don't officially know if they're going to be in here for a long time, if they're going to stick around or even be implemented. Now, tomorrow, the announcement is at 4 p.m. Eastern, purportedly. I say purportedly because last week we had the auto tariffs announcement at 4 p.m. Eastern, and we didn't get them in the middle of the show. We actually got them around 5:15, 5:20 p.m. Eastern. So there's a chance that the announcement comes when futures are closed or occurring at a point in the day where you can't execute any futures trading, right? Keeping that in mind, then it sets up for a very interesting open. Tomorrow night, 6 p.m. Eastern, 5 Central, you're going to probably have a gap in some form or fashion. What makes this so interesting to me is that when asked today by the press, the White House press secretary was, what plan is he effectively going with? And she said, my understanding is that the president will have a plan to announce tomorrow. Yeah. So it doesn't seem, I don't know why, I don't know what the incentive is to not announce the plan. Maybe, again, negotiating tactic, or all these other countries, they're afraid of what the announcement will actually say. So between now and 4 p.m. Eastern tomorrow, they fold, they do everything they can to, take down tariff rates. Israel did something similar today. They've been in a free trade agreement with the U.S. since the 1980s. And what have we seen? About 98% of their goods were tax tariff-free. The remaining 2% of the goods will now go into tariff-free as well. Perhaps that's the goal here. But there's the real politic of this all that is kind of scratching my brain. Dylan, I can't think of a time in my life when China, South Korea, and Japan agreed on a single thing. I think that's been a defining feature of global history for the past 80 years, that these three countries, generally speaking, do not get along. If only to that further underscore that point, Japan and South Korea were still having diplomatic rows a few years ago about how Japan treated South Korean women during
like
World
England,
War II.
Germany and France. I mean, Donald Trump unifies regional adversaries like nothing before his occurrence, whether it's the British, the French, and the Germans, or the South Koreans, the Japanese, and the Chinese. Everybody's now in the same room together because maybe your enemy's enemy is your friend, kind of thing. You're into a situation where why wouldn't China, South Korea, and Japan coordinate a unilateral retaliation against the United States? Why wouldn't Germany, Italy, France, and England all coordinate, and Spain coordinate a retaliation against the United States? Stop allowing the sale of any Apple products in Europe or Asia. Stop allowing the availability of any European or any American financial services companies in Europe or Asia. Stop allowing the distribution of any American entertainment products in Europe or Asia. Hollywood, Silicon Valley, and Wall Street are the three major exports to the world. And the billion odd people in Asia and the 500 million in Europe are meaningful export markets. And so, it's like if the American government wants to get crazy, then crazy it will be.
Well, the problem, of course, is that if what these countries do is they unify to free up trade between themselves, They help to insulate, and they help to keep the damage lower. If they unify to retaliate, everybody loses because everybody's costs go up. And so The Economist was actually making the argument that in this most recent issue, that the thing to do here would be to unify, to liberalize amongst yourselves, not to the exclusion of the U.S., because that would just saw down the branch upon which everybody sits altogether. But certainly that there is now this international reorientation to say, well, we need to figure out going to do all of this by ourselves, means that whatever new free arrangements they reach amongst themselves won't extend to the United States, and ultimately it's U.S. businesses that are going to lose out. They'll lose market share, they'll be less competitive, and all of the issues that we're supposed to be solving, the trade imbalance, assuming that's an issue, of course, but purportedly it is, and purportedly we're solving it with this, all of that gets worse.
Yes.
Yes.
Yeah, it does get worse.
All of it.
Yeah, that's like the word, if we erect these trade barriers and you think about the Trump tariffs in the first term, when we did the soft ag products, did China ever come back to the table, or did they just buy from Brazil? They ultimately just started buying from Brazil.
Yeah.
And Brazil's filled that gap permanently. So if China and Japan and South Korea work out a trade deal that reduces trade barriers among those three countries, right? Japan's turning around and saying, hey, we need buyers for our cars. South Korea says, hey, we need buyers from our cars. China could say, we can absorb that demand. Why not? We can structure a thing that allows you to sell your vehicles here. You need an export market? We can provide that to you, right? In exchange, you do XYZ for us. We don't want you to renew that American military base. We don't want it. We don't want, get rid of that THAAD. Outside of get rid of that THAAD deployment situation in Seoul, which is our terminal high altitude missile system to protect against, in theory, potential missile attacks from North Korea. Take that off your soil. We'll protect you now. It's a slippery slope, guys.
All you need to know is like the front of the Italian newspapers today in Milan was that the president of the United States has decided that he wants to take Sardinia along with Greenland and Canada, and that all the Sardinians should just move to Gaza because Sardinia is a strategic location for the American security infrastructure. And it was the Italian April Fool's Day joke was a cover article about the American desire to take a piece of Italy for security purposes. But the reason it's a funny joke is because it is not that far from the truth.
I actually I Googled it, not even connecting that it was April Fool's Day. I feel like such an idiot, but it's believable.
That's the thing. You're like, maybe.
I mean, stranger things we've heard.
Exactly. You're like, oh, maybe the American president does want to invade Sardinia. But the point of this gathering every afternoon, which I'm pleased to join in as you guys are, I know, is it's a trading discussion. And the one thing that chaos and uncertainty creates is opportunity. We've all kind of settled on long bonds as the sort of best probability situation. Gold has obviously been sort of a all-star or a risk-off positioning, as you call it up. And I guess it's to your point, Chris, it's like you have to be a fool. I want to say, listen, there's no way. I don't believe Donald Trump. I believe he's full of shit. And I believe you should be short the tariffs. But the truth is, I don't have enough confidence in that opinion to put my money where my mouth is, which is why I haven't prosecuted that here. However, Trump historically has been all talk when it comes to these things. And if that's the case, there's going to be a huge rally, particularly in the Mag 7 and the NASDAQ, which is sort of the leveraged growth scenario, if nothing happens. I'm not going to put it on because it just seems too crazy. But I'll probably kick myself when Trump doesn't put on the tariffs, honestly.
I mean, just being sincere about it, I feel like I can always talk myself into anything. Like, oh, I'm going to get long gold. Yeah, China's buying.
Yeah, you can find a way.
I can always find a way. It's one of the benefits of being raised by two attorneys. You learn how to make an argument. I can make an argument for
most anything.
Yeah, I can justify most about anything. And like Dylan, worst comes to worst, we can always use the timeless better men have done worse things excuse to justify our moral shortcomings, especially in markets. I don't find that power within me today, and it's been decreasing over the course of the session. I don't know why.
What would you be attempting to even explain?
I feel like
in other words, using your dual legal parentage, if you were trying to talk yourself into a position, what position would you even attempt to talk yourself into?
Good question. I feel like I keep getting asked the question, what's the trade for tomorrow? I have no clue what the trade for tomorrow is. I have no idea whatsoever. I have no idea if stocks are going to go up, bonds are going to go up. I'm not leaning strongly one way. Ilya, you say strong convictions loosely held. How about no convictions held whatsoever? It's a total crapshoot as far as I think it's a total crapshoot.
Will there be movement or no movement? How about that?
I think there will. I hope there will be movement. Okay. The worst possible outcome for me is if this market does not move and chops around for the next few days. That would be the most frustrating situation. At least if we got a break to the downside, okay, new lows, the growth is going to be, growth is coming in. We look at FactSet, we can see the tracking that they're doing for earnings from Q4 2024 to Q1 2025, and there is a drop off in the year-over-year growth rate. We're seeing more companies are guiding negatively for their earnings at a higher clip above the 5 and 10-year averages as we make our way into Q1 earnings season, right? I could put together that narrative in my head. Yields down, stocks down, economy's shrinking, right? Corporate earnings are down. That's the bear Goldilocks scenario, right? If the bull Goldilocks is expanding corporate earnings, labor market at 4%, CPI coming closer to 2, real GDP between 2 and 3%, earnings growth year over year positive and expanding, then we are in that bizarro world where literally all of that is moving in the opposite direction and on its head. So it's very easy for me to say that, okay, we should be looking for lower yields, higher gold prices, yada, yada. But on the other end, if the market comes out tomorrow and rallies because of these 20% tariffs, doesn't that mean we should start immediately embrace the idea that perhaps we found a North Star? And that after dealing with all the costs and chaos of the implementation of the tariffs, we finally have that direction. And now we can do the business planning and we can do the supply chain reshuffling. This, that, the other thing. That's putting this completely in a vacuum and ignoring the fact that there's the possibility of retaliations by other countries who seem very willing right now to stick up to America and put us in our place. If you follow the international news, if you look at the polling abroad, America is at one of its lowest points of popularity in my lifetime in 35 years. Do I trust a market rally, Dylan, if I think that American exceptionalism is dissipating, that the TINA trade is dying because all of a sudden there are alternatives in the world with all this capital being deployed elsewhere?
Well, how about this? Let's try this a different way. Let's say you take the Trump administration at their word, which is they are dedicated to the end of globalization, the reestablishment of a domestic manufacturing economy, the reduction of income taxes, especially for the wealthy, and the replacement of the reduced income taxes by tariffs, which will, massively reduce imports.
We would need to.
That'll drive a U.S. manufacturing boom.
Well, hold on. Just for the tariff math there, we would need an effective tariff rate.
I get it. I understand.
Closer to 55%.
I got it. I understand all the sort of absurdity that's in here.
Okay, sure.
But does that mean we're buying AutoZone? Does that mean we're buying O'Reilly Auto Parts? Like I'm saying, like let's say we set aside our own political preferences or ambitions for our children or the world or our hopes for whatever. And we're like, okay, there's an iron curtain around America. No one is allowed to leave the country a la the USSR. And the only thing you can do is buy and sell products inside the United States. Who benefits?
The essence of the problem is that there is no answer to that question. And if stocks and businesses and consumers had an answer to the question, they could discount it. The appropriate securities could go up and down. The appropriate interest rates could go up and down. The appropriate commodity prices and currencies could go up and down. They could find their new levels, maybe in a chaotic way. The detox that we've been talking about, that Scott Bessent, the Treasury Secretary, has been talking about, could occur. That is to say, we could transition into a different world order. Things could be extrapolated out, and then we can actually answer the question, and markets could know, and there could be certainty. The problem is there is absolutely no way to answer that question here. No way to answer it because we don't know what reciprocal tariff means. We don't know if, as we were saying before, it's tariff for tariff, average tariff rates, effective average tariff rates that include non-tariff barriers. Is this meant to restructure the system? Maybe. Is it meant as a negotiating tactic? Maybe. If it's a negotiating tactic, is all of it subject to change within a week to a month to a few quarters? Maybe. Nobody has any idea what we're dealing with. That's the issue. We don't need to, I think, go too far to look at markets and say what's driving them isn't the knowledge that this policy will do X or Y. What's driving them is the absence of that knowledge.
Yeah, I mean, we can look at AutoZone, we can look at O'Reilly, right? Those companies have certainly done well. They've been on lists for years of companies that would do well on tariffs. But there's also companies that make you can't import makeup from abroad. It's not like Elf Beauty's been doing well. What about JB Hunt? You're going to have to ship more things domestically within the economy, so a lot of trucking activity, right? What did we see immediately after the election? JB Hunt actually jumped to the upside. We go into the month of November. We opened up at 180.62. Shortly after the election, we were at 200.40, right? Tariff delay, tariff onset. Every time there's a weekend of tariff news, JB Hunt's been opening to the downside. So net, there are companies that will benefit. That's the nature of tariffs. It creates political artifice where protected industries and actors within those industries do well at the corporate level. We can make the argument about bringing manufacturing jobs back home. That is an argument that is made on paper. It is theoretical at best. We have recent history from the George W. Bush steel tariffs, from the tariffs in Trump's first term. Fewer jobs in those sectors. Fewer jobs in steel-consuming sectors in America. Steel-producing jobs went up marginally. Steel-consuming jobs went down bigger. We lost jobs as a result of those tariffs. Dylan, you say if we take the Trump administration at face value, what do we get out of this? If we take the Trump administration at face value, as we joked a few weeks ago, detox and transition, that's just fancy words for recession. We're getting a recession. We're going to get a recession. That's what's going to happen. It's also in the back of my head, why else would we trade anything other than long bonds and gold in 2025 if the administration is telling us that they want to do things that lead to recession? We're going to tear down the market to put in new policies to hopefully build it back up to where it was. I do see a headline here coming out about taxes, a few things about taxes from the administration. Yesterday, it was floated that they would potentially raise rates on high income earners to pay for no taxes on tips. Several House Ways and Means leadership members, Tom Emmers, Mike Johnson, came out today and were directly quoted to Punchbowl News and Politico as, quote, ha, 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 no. So I don't think we're going to get a hike in the tax rate on millionaires and billionaires to pay for no taxes on tips. I'm not sure where that goes. Another tax headline that comes out today, SALT tax cap extended up to $25K in the next House bill is currently being discussed. Again, we'll see what happens. But if we're taking everything at face value, Dylan, we still have soaring deficits. They're talking about bumping up the debt limit by $4 or $5 trillion. So you're going to still have soaring deficits. You're now going to have weaker growth, higher structural inflation, and a diminished U.S. role in the world. There's no other currency to step in and serve as a safe haven right now. We can talk about the yen all we want, but the yen's going to deal with its own problems if these tariffs come down the pipeline and they don't have an immediate outlet for their own exports themselves. It's not going to be fun. I like gold still. Gold had a decent day today. It closed up at a new, well, not quite at a new high, hit a new all-time high before pulling back in at the end of the session. We're at 31.52 right now.
So basically, whatever it is, we're saying we're long recession.
I've been
long the bond, long gold. Is there a
we're
short
long recession firefighting? Whether we actually get a recession or not, I think that's history will tell us. We won't. I mean, to Tony's point on last call, we don't know that there's a recession or there's been a recession until after the recession. What we're looking for here isn't to confirm recession from an academic point of view, to pat ourselves on the shoulder and go, look at that, we called it, baby. No. The idea here is to trade expectations of recession firefighting. Not even the firefighting itself, whether it materializes or not, who knows? We'll hear from Powell on Friday. He'll tell us some stuff. The key here is that you're going to get some outcome, and the thought process as a trader is, will markets take this outcome to speculate on the firefighting more or less? And I think the answer is more.
And by the way, this isn't just like a thing that the three of us, Portola wine crowd, New Yorkers, blah, 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 East Coast liberals, elites, whatever you want to frame us as, are discussing. This is a consensus view that recession odds are rising. Polymarket, which, no one confuses with being a place for people
lefty,
on the...
Yes.
I mean, I just fundamentally think that if you're going to be a trader and if you're going to be someone who operates in Polymarket, which is, again, adjacent crypto, you probably fit a profile of someone who's at least moderate to center right leaning, okay? And having done the prediction trade with Jeff Joseph for so long and having done the interviews and conversations with people in the industry, it's generally leaning a center right to the right group of men who are participating in these markets, particularly Polymarket, right? Kalshi's a little bit more center, but Polymarket's a little bit more center right in terms of user base. That's not a good thing or a bad thing, but it speaks in terms of the bias. The bias here would perhaps be to undersell recession, right? But we're at a 41% chance. We go from at the start of the year, right, when this contract initiates, it's at 20 cents. It's now more than doubled to 41 cents. It's gone up over the course of the last few days as the stock market's gone back down. And maybe you'd argue that this is effectively an inverse indicator to the stock market right now. It certainly looks like an S&P chart upside down from the end of February onwards, right? You get that little bounce in the middle of the month, and now we've sold off again the last few days as recession odds rise. Nevertheless, right, it does appear that the market is thinking, it's behaving as if the possibility of recession has been elevated. And the writing was on the wall. The writing was on the wall a few weeks ago. You saw it in this February PMI report, Ilya. And that's effectively what we're writing here. We're not betting that it's definitely going to happen, but the accumulation of evidence is moving into that outcome right now. And so riding the waves of that trend would mean lower bond yields. As long as we don't go to a correlation one event where everyone sells off everything, gold probably stays elevated. And I would point that out, too, because gold does really well if we think about stagflation, Ilya. And this ISM report today screamed stagflation impulses making their way through the economy.
Yes, it did. Yes, it did. Just by the numbers here, I'll read them off to you. The price component of this was the highest, the price growth component, measuring the speed at which prices are growing for the manufacturing sector, fastest since June of 2022. So right in the heat of the peak inflation scare. The sector itself contracting for the first time since December. New orders shrinking at the fastest rate since, give me a second here, May of 2023. Employment shrinking at the fastest rate since October of last year. And I'll read you a quote here from the report that I thought was telling. Demand and production retreated and de-staffing continued. This is a fun term because some of the respondents were saying we're not laying people off, we're reducing redundancies and allowing people to come off the rolls with retirement without hiring them back. So we're not backfilling people. So ostensibly these aren't layoffs, but de-staffing. But anyway, these things continued as companies responded to demand confusion, and price growth accelerated due to tariffs. A parallel survey gets confirmed from S&P Global today. Their take is, and I quote again, U.S. manufacturing sector growth stalled in March because of uncertainty linked to concerns over tariff implementation and federal government policies.
I think the spread that we see between the prices and the new export orders here, the prices paid
says a lot.
Jumped to its highest level since 2022. New export orders are now contracting and declining. All of this is in the face of rising inventories. So we have rising inventories. We have orders falling. Okay, so stuff is starting to pile up on the shelves. There's not a lot of demand for it, and the cost of building the new things that fewer and fewer people want is going up. Is there any incentive for these firms to continue to grow right now? The answer is no. The ISM Manufacturing Index falls into contraction territory now. It's a really ugly mix. And you could say for 2023 and 2024, hey, we were in contraction territory for, a bunch of the time. That's fair. We were. But that bounce that we saw at the end of 2024 in the beginning of this year is now increasingly looking like the thesis that was laid out, which is, are we seeing imports and demand pulled forward ahead of the tariffs? Some more anecdata along those lines. We see that Hyundai and Nissan are reporting their best weekend of sales in the U.S. since pre-COVID, as they put out some deals for avoid the tariffs. Same thing for Ford. Same thing for Toyota. Car dealerships are seeing their numbers jump, which I guess means I have to get to a dealership before 4 p.m. Eastern tomorrow to get my new car. Crap. Damn it. This is just, like I said before, I'm tired, boss. It's just.
It's like he's targeting you personally.
Well, if I get the SALT deduction and, yeah. But then again, I'm also in that, Rick Sanchez. It's like, I've seen what you people cheer for. Your boos mean nothing to me. So it's just, when do the Mets play today? We got 2 hours until game time. That's just delightful. Oh, I'm going to be able to watch the Mets on my deck in the sun today. Ugh.
So what you're leaving us with? Long bond, long gold. I mean, it's come down to this. Well, we can't go near the Mag 7. We got nothing on oil. We got nothing on the banks. We can't do anything in retail. We got nothing in consumer discretionary. We got nothing. And I guess you got your electricity. You have your AI electricity long position. Does that you got Duke Energy, Exelon, gold. What about maintaining the European long position, the Euro rally, meaning the Euro equity rally, not the currency rally, but the
if you look at
German, Italian,
if you look at European
French,
equities, they're sinking.
Well, hold on. Ilya.
I know.
Ilya, if we're talking about if people miss the breakout here, right, like risk to reward, the former highs that we have last May and September that we based around here as we turn through February, this is.
But this is in dollar terms.
Okay, so we do HEZO, which is the hedged European equity index. I don't know, man. This looks like we're carving out a
breaking
both.
down.
Oh, see, this is how I can't. You're such a pessimist. My natural optimism is like, oh, that looks like a bull flag.
Yeah,
Right?
that looks like it broke the preceding low and is now backfilling. Take a look at it on a 4-hour or an 8-hour. You can see it.
No, still looks like a bull flag to me. But Dylan, if you just said the value of everything on planet Earth is now 10 to 20% cheaper as a result of this global economic regime change we're embarking upon now, then wouldn't that also mean that European equities, despite their inflation, or
no, it would. I'm just saying, like, if you think about like what has been working, bonds have been working, European equities were working, your utilities were working. Natural gas was working for a minute. I'm just thinking about like where there's been some positive, where there's been price appreciation, and where does price appreciation live? And here the natural gas rolled over, Europe's rolling over, bonds not rolling over.
I don't know if European equities have been working. Being long the euro has been working, but since
European, look at the
peak in March. Index. Well, I mean, since the peak in March, the actual euro stocks index, not the derivative ETF, which is constructed in U.S.-based terms. The actual Euro Stoxx 50 index, since its peak on March the 3rd, is down 7.5%.
March the 3rd was 3 weeks ago.
Exactly. This is a pall upon everything because, to your point, this hurts economic activity for everyone.
Report out here from the Wall Street Journal that the U.S. Trade Rep's office has been asked to give Trump a third option for tomorrow's tariffs. Oh, there's no plan. There's no plan.
Either that or the show is this good and we are that dumb.
No, the only show
to fall
that's
for it
right
again
now,
and again and again, because the misinformation leaks aren't misinformation. They're leaks on purpose to keep the show on edge.
Okay, so I really think, the whole talk of a Trump third term is just totally nonsense, right? It's constitutionally illegal. I've studied con law. This was one of the cases. Like, how come, why has this been a non-thing since FDR was president? And like, I specifically remember going through all this. It's a real non-issue to me, but it's the kind of thing that plays right into the, resistance liberal, emotional wheelhouse of Trump being a dictator and, a fascist and America's Hitler, yada, yada, yada.
And now let's talk about it for 90,000 hours.
So we're going to focus on this as we head into tariff implementation week. And oh my goodness, none of the other countries that we've been trying to shake down have responded in the form and fashion which we thought they would, which would ultimately be caving immediately to our demands. And so let's put a distraction out into the media ecosphere so we can try to figure out this tariff thing after declaring it Liberation Day. And then I just put that in the context of the headline I just saw now where the Wall Street Journal reports the administration is asking the USTR for a third tariff option for tomorrow. Dylan, this feels like asking your teacher for an extension the day before the essays due. Don't really know how else to put it.
Or it feels like as predictable as a rallying oil price in the face of Iranian retaliation as an opportunity to short oil, that a global anxiety attack about Trump doing tariffs is as predictably false as a Gaza or as an Iranian retaliation.
I mean, that certainly could be, by the way. It certainly could be that what the markets walk away with tomorrow is, oh, now we have certainty. And the more you keep the situation uncertain now, the more like certainty it looks. And the more like certainty it looks, the more markets rally in relief, and you get to parade around and go, see, told you.
You know how I know tomorrow's going to be a disaster?
I love the premise.
Uh, in Paulina, the the Republican congresswoman was trying to put up a rider to a vote today to allow new mothers and fathers to vote by proxy in Congress, which is something that they've allowed previously during emergencies. And the rider did not pass. And then Speaker Mike Johnson canceled all other floor activity for the rest of the week. It's Tuesday. They just cleared the congressional calendar until next Monday. Small things, small pieces of writing on the wall, right? Small pieces of writing on the wall. Reps are being sent home. They're leaving DC this week. Now, that sets up an interesting dynamic. Do you really want your reps back in district to deal with this? Now, I bring up Newsmax here, though, because it's Trump world adjacent, and it is the hottest IPO ever. What a chart. Opens up at 14 yesterday, listed at 10. Bankers really dropped the ball here. They really dropped the ball. Closes today at 242. Dylan, wow. This has a bigger market cap than Fox News now, even though Fox has about 1.2 million viewers on average in prime time per night. Newsmax has about 240,000 viewers on average in prime time. They also only had $80 million of revenue last year. Thank you, Nick Batista, for that info. Unfortunately, it is impossible to trade right now. The margin on shorting it is about 550%. There are no listed options yet. Dylan, is this the madman's delight moving forward? This share has gone, again, $10 up to $242 in 2 trading sessions. What are we doing here? What's the plan?
Do you want to get, I mean, that is an existential question that I shan't attempt to answer as it pertains to what are we doing here. Are you suggesting a put on Newsmax?
When the options are listed, right, we can't trade them yet, and it's impossible to short. It's just too expensive to do so. But I don't know. That seems like a lot in a little bit of time right now. I wonder what the window is that they can't sell their shares. Gosh, to be an insider right now and be sitting on a position where your equity is valued at $10 on paper and now it's trading $242 in the market. Nice problem to have. Either way, though,
shorting TMTG as a stand-in. Trump media.
Yeah, DJT. It's 5.1 IVR. I don't know if that's a good stand-in. Plus if you're following what's happening with World Liberty Financial, and they're building more bona fide streams of business. One of the Trump boys, I forget which one, is on the board of Kalshi now. So they're branching out. It wasn't worth $80 a share, of course, when it was up there, but is this company really at bankruptcy risk for the next 4 years, Dylan? I don't think so.
Obviously not.
Obviously not. All right, Dylan, I want to, you start talking about existential questions here, and I want to give you the floor here as we end the show. There's a special election tonight in Wisconsin. Elon Musk is calling it the most important judicial race in human history. It could very well determine whether or not humanity gets to Mars. You've covered a lot of politics and finance in your time. I don't know if I disagree with Musk. It feels like today is a really important vibe turning point because there's also special elections in Florida. Do you look at this first 72-hour window here at the start of April between Liberation Day and these special elections as a critical turning point for the market, perhaps not just for this week or next, but realistically for the next several months, maybe the rest of the year?
No, I don't. I think the market will function based more on the degree to which the executive suite has to continue to pull their punches as it relates to investment in the future. And I don't know that is entirely determined based on the next moment in time or the next 72 hours. However, I do believe that the next 72 hours are significant insofar as they represent the first referendum on the political power of Elon Musk, because Elon Musk has been deemed to be the ultimate kingmaker by virtue of the Trump election in November. And there hasn't been an electoral event that's been a referendum on Musk's power to control as a political kingmaker. So I believe that really with the next 72 hours is much more of a referendum on Musk as a relevant political factor. I say that because there's been actually a decent amount of polling anyway, and who knows from the polling, honestly, but that suggests the more Musk jams his beak into the Wisconsin election, the better the Democrat does. That Musk is actually a negative electoral force at this point. And that would be a meaningful turning of the worm, more so than anything as it relates to the market. So I think that this is as more than a referendum on economic or prosperity or growth. This is a referendum at this moment on the continued influence and relevance of Musk himself in the American electoral process. And it will either empower him further if the outcome is to his preference, or it will alienate him in some way and sort of cause a bit of a pause, surely not an exit, but a pause, if in fact the outcome is opposed to his preferences. But I think it's more of a Musk referendum than it is a market referendum.
Well said. And with that, overtime is now out of time for this Tuesday, April 1st, 2025. No April Fool's jokes here. We'll be back tomorrow for Liberation Day. Same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So we very well may be covering the tariff announcement live. Be sure to tune in. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. Good luck trading. Stick around, though. After a brief break, there's more Tasty Live. Ilya Spivak, of course, is back with Macro Money.
See you there, everybody.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
So I've been trading for about 5 years, maybe 8 to 5 years, and I got in the options world because I wasn't making enough with just holding long equity. There's not a lot of strategy. It's just sort of like buy it and then pray it goes up. I found Tasty Live from my friend, and I started looking at the YouTube videos. My favorite part about it was just that there was math, there was probability, it was something you could consistently rely on. Once someone gets the right information, which they provide on Tasty Live, they can really change their financial situation for the better. Consistently, not, I bought a stock and it went way up one time, but how can you do it consistently, over and over? And with Tasty Live, I was able to do that.
How we respond to the most difficult situations is ultimately how we learn to build on our successes.
It takes the guesswork out of retail trading.
I'm running Snow Leopard with this. I'm a Mac. I'm a Mac. I'm a Mac. G. Multitask, MacBook handler, brother. iPhone in one hand, iPad in the other. Pop open top, Apple logo shining on the back. That's why all these player haters know that I'm the Mac. Easier to see a nun with VD than to see me ever typing on a PC. So if you got one, you can play a sad tune and play it back later in your room on your Zune. Windows made to break, and I'm here to crack it. And if I'm a Mac, that means that I'm immaculate. Style so clean, like it's disinfected. Clean surfaces where white light is reflected. Plastic case, Apple Store, keep my phone protected. Check my toolbar to see if networks are detected. Use my side swipe, applications hidden in it. This is Mac world, bitch, you're just living in it. I'm a Mac. 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 Roll into the coffee shop, know I'm on a power trip. Strapped with my laptop and my own power strip. Your outlet, about to make your cable drop. Apple logo shining off the marble on the tabletop. So if you see me, then you see a star. Any place I sit down, call that the Genius Bar. Looks like I'm working hard, but to really know the truth, just taking pictures of my fine self in photo booth. Interface simple, why I need a Kindle. Working on that pad keeps my fingers mad nimble. So if you think I come up short, you must be wrong. More than one reason that these ladies call me Justin Long. I'm a Mac. I'm a Mac. I'm a Mac. Yeah, Justin Long, son. You catch that? Known by the ladies as the toolbar. 10-hour battery life. Force. Quiz.
Oh, yeah. Tasty Nation, good morning.
You know you need it. Got to know.
On today's Trader Taste Test, we are going to the first Chicago location of Voodoo Donuts. Let's go. Okay, you guys.
Voodoo.
So we got a dozen of the classic Voodoo and then a dozen of the Voodoo dozen. So.
These are basic.
Basic?
This one.
Okay, that's gonna be your taste test.
Good.
How many stars do you give it?
3 1/4.
You gotta-
See, this doesn't work for me. This is for children. That's why there's cereal on top of it. This is my jam. Nice old school donut.
Old school buttermilk.
All right.
It's not a crow.
Okay, what do you rate it?
3.25.
That's sweet.
3 point. I know, because I've trained him how to be a market maker.
Now we load up the flotilla.
In the money. It seems pretty easy to understand. If I'm in the money, I must be profitable, right? Not quite. In the money is in reference to the option's strike price relative to the current price of the stock. An in the money option is an option which has intrinsic value. For a call option, that represents an option with a strike lower than the current stock price. For a put option, that represents an option with a strike higher than the current stock price. Being in the money is a good thing for long options. It's not so good for short options.
Well, the markets look uneasy as we await quote unquote Liberation Day, the day where we're going to get an expansive announcement of what could be a vast remaking of U.S. trade policy, what could be a centerpiece of the economic pivot that we see with the new Trump administration, what could be a negotiating tactic, what could be something that ends up lifting the markets or sinking them. And the operative term there is could be, because the lay of the land here seems to be that we really don't know what it is shaping up to be. And this is what we're going to talk about here today on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. The question before us, of course, because as ever, as traders, we cannot tell the future and have to try to figure out how to handicap a range of outcomes, is whether stocks, which have been aggressively beaten down in anticipation perhaps of what we have coming tomorrow, we'll see, whether that beating can now cease. Because, of course, as we know, when markets see speculation be met with reality, they discount that reality. Whatever adjustments take place we move on. So are we getting to a place where these markets are ready to bottom, or are we getting to a place where the pain is likely to multiply? This is at core the question as we head into this announcement, and of course have to trade around it with lingering uncertainty. And of course, uncertainty is forever the feature of trying to trade a future one does not know. And so even in this very tenuous situation, there is perhaps a trade to be had. And so let's break this down piece by piece. So, of course, looking at stocks here as a starting point, this is how the S&P 500 has responded as a kind of catch-all for market-wide risk sentiment and certainly Wall Street risk appetite. We can see that since the second half of March, we've had this precipitous decline. There was a little bit of a corrective rebound, obviously, here at the start of March to retest the underside of the range that we ultimately broke through along the way of these shattering 4 weeks. And we are now back to pretty much where we started. Those lows from earlier in the month is where we're once again kind of huddling around over the past day or two. Moreover, as we try to retest back through what was former resistance turned support, a kind of inflection zone right here, that's holding up as an upside barrier after we broke through it to the downside. So it's as if we got to a point of maximum concern here, and having had a little bit of relief, we've now returned to the decision point, the place where the initial sell-off stopped and where we have to make a decision now about whether the problem has been duly priced into the markets and we can move on, or if it has not. It's a parallel story for the bonds. We can see here that as stocks have been going down, so too bonds have been going up since the beginning of the year. And here also, since the beginning of March, the move ran aground, pulled back, and has now returned to that early March starting line. We're back to the early March starting line on the stock sell-off. We're back to this early March starting line on the bond market rally. Now, what is all of this about? Well, needless to say, the operative conversation is about uncertainty vis-a-vis tariff policy and fiscal policy more generally. Just today, we got the updated ISM Business Confidence Survey, a PMI survey. This is giving us the latest on where U.S. Purchasing managers who are at companies with the task of looking forward, anticipating economic activity, and thereby figuring out inventories, figuring out staffing levels, figuring out how much capacity is needed. And so in that this is their vantage point, they are useful to poll about where the economy appears to be heading. This was where they were in March, according to this particular survey, this Institute of Supply Management survey. And we can see there was a contraction in the manufacturing sector here, as expected, and a faster one. This index operates around a center line at 50, where that's neutral. Above 50 is growth. Below 50 is contraction. And here we are below 50. The further you go below 50, the faster the contraction. The further you go above 50, the faster the growth. So here at 49, we have contraction, and it's faster contraction than what the markets anticipated at 49.5. We're going to get the service sector update later this week, but for now, here are the internals of the manufacturing side. They are, in plain English, scary looking. This surge in the prices component, suggesting what the input costs are and what the pricing structure is in manufacturing, point to the fastest inflation since the middle of 2022, which of course was near the peak where the Fed's firefighting finally started to have an effect in the second half of that year and inflation started to come down. So a blistering rise in prices, even as we get contraction in both employment and new orders, and indeed the fastest contraction in some months. So what does the report make of all this? Reading directly from the ISM report, quote, demand and production retreated and destaffing continued as companies responded to demand confusion and price growth accelerated due to tariffs. In parallel, we got a revision of a similar PMI report, this one from S&P Global, same type of data, again, centered around 50, all the same rules apply. But this one from S&P Global, in fact, this was the survey that really kicked off these concerns for the markets when it started to report this slide in not just manufacturing, but the service sector, and with it, the overall economy. So these numbers, it very interestingly show a front running of the tariffs and manufacturing improving against that back story, and now turning down to basically standstill. These numbers initially had a slight contraction when they were preliminarily reported, and these are the preliminary numbers for services and the composite that will be revised later this week. This is the final number that was reported today. It's a little bit better than the ISM one in that the ISM one is contracting and this one is basically flat, showing manufacturing is essentially stalling. But it was this survey that showed us that what we've been seeing is a sharp decline in service sector activity, and the service sector is a much bigger part of the overall economy. As we can see, the composite that includes both manufacturing and services basically follows services because it is close to 70-80% of the economy, depending on when you look. And so when we look at this, then this was where the markets really started to get concerned. They said, uh-oh, it isn't that we didn't know that there were tariffs coming. It isn't that we didn't know that a retrenchment on government spending is coming. We knew all these things back in November. What we didn't know, and what we continue to not know, is implementation, to the extent that tariffs come on and they come off, plans change frequently, the nature of the expansive, broader plan continues to be clouded. And so what that's doing is it's telling businesses, don't spend money, wait for the environment to become clear so you can make your 6-month, 12-month, 24-month inventory, staffing, investment decisions. And what that's obviously done is it's ground activity to a slower level. The same thing, of course, showing up on the consumer side of the ledger. Here, consumer confidence has fallen off and inflation has surged, again around the same story. The respondents to this survey from the University of Michigan are universally citing that, or at least in mass numbers, universally is probably too strong a word, but in mass numbers citing the issue around tariffs uncertainty as part of these decisions, and suggesting that what the tariffs will do is they will boost prices for things, and so much as a tariff is basically a consumption tax on imports. And so we have seen a surge in inflation expectations back to 5%, again, near the peak from mid-2022. Notice the extent to which this lines up exactly with what's going on in this ISM manufacturing survey. And confidence has, of course, fallen off back toward the lows of this inflationary cycle. It was once inflation started to come down, the expectations started to come down, and once those started coming down, sentiment started to improve. Well, we're back toward the starting line here, both on current conditions and on expectations. And of course, with current conditions, it's a little bit better. With expectations, it's a lot worse, and overall sentiment subsuming both indexes lies somewhere in between. In response to all of this, the markets have of course, concluded, especially after the administration has dismissed their concerns, that the relief is going to have to come from the Fed. And so what we've seen is a significant dovish shift in policy expectations, again, since mid-February, as all of this started to hit the fan. You'll notice this looks quite a bit like what the S&P looks like here, a sharp down move and then consolidation after a little bounce, then back toward the low. Consider how much that looks like this, a sharp down move, a quick bounce of relief and consolidation back until you come back to the low. So what you're seeing here now is 73 basis points in rate cuts for this year. That's 3 cuts effectively baked in, 31 basis points for next year, at least 1 cut, and some chance of a second, about 6 basis points in the direction of a second next year. In all, 104 basis points in easing being priced in, whereas at the beginning of this move, we were looking at maybe about 50. And at the start of the year, maybe somewhere between 50 and 75. And so with that is how we look at what comes next and the market reaction. So we can see here that initially all of this looked like a growth scare. That, of course, comports with falling inflation expectations, falling yields, and a falling dollar anticipating Fed rate cuts. But what we see now is more ominous still. Inflation expectations have started to come back up. Meanwhile, yields remain depressed, and the US dollar is hovering near its lows. So we appear to be looking at the very issue that the Fed was highlighting in its most recent update of economic forecasts. This is the latest set of numbers, and the Fed was very clear, saying, we don't know what this is going to look like, much as nobody else appears to, but we do know that historically tariffs are bad for growth and tend to boost inflation. So what we're going to do is we're going to increase our inflation expectations for this year at the headline, 2.5 to 2.7, 2.8 at the core. Next year, an increase as well. And we're also going to lower our growth expectations from 2.1 to 1.7, from 2 to 1.8 next year, and even a little bit out to 2027, although by that stage, it's really very difficult to forecast. So those are very loose numbers, as it were. And so the expectation for the markets, ostensibly then, is the relief valve to all of this, at least that's what the markets seem to be saying, is more easing. Because to the extent that tariffs hurt growth, they are going to lead interest rates lower, because that lower growth will pull down on inflation and give central banks more room to cut. In fact, if we look at the policy expectations for a whole range of central banks for this year, we can see that for all of them through this period, the outlook has become various versions of slightly more dovish, be it the Bank of Canada or the U.S. Or the European Central Bank, even with its recent rethink of what may happen next year around the inflationary impact of defense spending, and of course the euro's rally around that. Nevertheless, all of the expectations for this year, against the backdrop of all of this tariff uncertainty, all of them have moved toward more dovish settings, with the exception of the Bank of Japan, where rates are moving at such a snail's pace and are so low relative to everybody else that we've gone from a slight bias to hikes to basically standstill on expectations through all of this. So modestly dovish in that we have stopped the incline here and shifted to neutral, but considering how low rates are here, that's enough of a shift to give you symmetry with the tone that's going on here. And therein, then, is the trading essence of what comes next. Now, the problem for the markets with these tariffs, as we've alluded, isn't that they are coming. It is that nobody seems to understand what exactly is it that is coming. The president has talked about reciprocal tariffs. And the idea isn't so much that it's just tariffs, but reciprocal trade barriers, meaning that he would like to mirror U.S. trading partners' policies back at them. That is to say, if a country is applying a certain tariff on the U.S., we want to do exactly the same thing in reverse, which sounds sensible in theory, perhaps, but what that actually means is a complete black box. For example, The Economist anticipates that if we actually went tariff for tariff with each trading partner, we'd have 2.3 million new taxes. Just new tax rates, new tax numbers to keep score of. If instead of targeting individual policies, we said, okay, we're going to normalize average tariff rates. So if a certain country has, on average, XYZ tariff rate, we're going to try to do the same. But how does that account for non-trade barriers like quotas and punitive regulatory barriers that some countries have? All countries have against one other trading partner or another. And how does that factor into this? Because the president has said he wants to have reciprocity there as well. How do you calculate an effective tariff rate? Do you just put a blanket one on everyone? That's kind of what we have now. We have a single external facing tariff for everyone, irrespective of the trading partner. And maybe what all of this means is just an increase in that. Nobody really knows. Moreover, it's unclear if these tariffs are a negotiating tactic. That is to say, they might get negotiated down, and so whatever is announced isn't the final answer, or if they're an attempt to, in a long-term way, remake the system all in one shot, and this is that announcement. If you look at the conversations that have been had between the U.S. and Mexico and Canada in recent weeks, then you know that renegotiation can happen with a phone call and changes can be swift. So is there really more uncertainty here even after this announcement, or isn't? Seems to be the crux of the matter. All of this consternation in business and consumer confidence surveys is, again, rooted primarily in uncertainty, not in tariffs as such. Them we've known about for a long time. And so the key here then is, does this Liberation Day announcement give the markets and consumers and everybody else looking something solid to extrapolate over time? And on that basis, to take action. If the answer is yes, then perhaps stock markets can find a way to like it, at least in the diminishing uncertainty of the environment. But that there is tariffs is itself a growth scare. And that might beckon more easing. And in that sense, bonds may keep going higher all the same, because of the expectation that whether the environment is certain or it's uncertain, the Fed will have to do more heavy lifting on the growth side. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. As ever, today, in just 30 minutes' time, as it is every Tuesday, I'll be on with Victor Jones for The Price of Truth. I am on with Chris for Futures Power Hour this Friday, back with Victor and Tom for First Call this coming Sunday, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money's back tomorrow.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live research team and on-air personalities post refreshing content updated daily, covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again. Oh, good. So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies?
Excuse me?
I do. My parents are watching. They're sitting on a rainbow. I'm a half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Yeah, talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive?
What?
Uh-oh, watch yourself. We don't want to get hit by a car.
Oh.
My brother did that once. He can't talk now.
Oh, my God, I'm serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11?
Oh.
First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank you.
Does anybody ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
What is going on, everybody, and welcome back to Risk and Reward with Gus and E. We got some things to share with you today. We'll do a little tour to market. Before we get into that, and our slides for today, Gus, my brother, how we doing?
Oh man, doing great. Happy with the rebrand. Happy with the new show. That lovely intro that just played for the first time is awesome. Our GFX team and our production team does such a wonderful job, and yeah, excited to be here and get into some things.
No, 100%. They kill it every time. I liked it. I love the colors. I love everything about this. I'm excited. Risk reward. I know we're going to get into risk of the week today. It's going to be something new, something different. We'll explain the rules here in a little bit, but we're going to start putting on some risk, and we'll break that down. Before we do get into that, April Fools, Gus. I didn't have any tricks up my sleeve today that I would have wanted, but popping up on here like a couple minutes late would have been funny too. But it's past that now.
Yeah, I didn't really pull any pranks or do anything nefarious myself. Got to upload a funny video of Tom trying on some suits that Todd bought for him. So
nice.
That was a fun one. But yeah, no antics around the office, nothing to that end. And I'll tell you what, I'm an easy person to get on April Fools. 'Cause I don't know what day it is ever. Sometimes I wake up on my birthday and forget what day it is. And so, yeah, if people pull things on me on April Fools, I'm buying it. I'm buying it pretty much until you do the big reveal that today is April Fools. It will never click with me. And I've always been one, like sports pages I follow will post like crazy, ridiculous fake trades or whatever. So, yeah, and I'll fall for those too. My Texas A&M Aggies basketball coach actually announced he's leaving the program for Maryland today, and I hoped that was April Fools.
Oh, no way.
It was not. So
okay.
there's a sick prank that my university pulled on me there, I guess.
Yeah, I'm kind of on the same boat with you right there, because that is a pretty crazy move, though, in terms of the coach. But I was on Twitter today. A couple things. There were some things within the trading community that I had seen, and I was going through the threads. I was like, no way, this is real. And I had to keep going. It was like fooling everybody. And then I was like, oh, right. Today's April 1st. So I know tomorrow is my baby sister's birthday. So she was barely born on April 2nd. I remember when she was born like 7 years ago. I was like, man, you were so close to the April Fool's baby. I would have been the best big brother if you had a birthday on April Fool's every year. You would have loved me. But anyways, before we get into it for today, Gus, anything else in the market? I know it's the second day of the market. We have a resolution on tariffs coming this week too, which is going to be April 2nd, which is tomorrow.
Liberation Day, a national holiday. I've marked my calendar.
Oh, there we go. You're ahead of the curve on that one.
That's what he's calling it. But
yeah,
a lot of uncertainty in the market surrounding that right now. I am kind of leaning into that uncertainty a little bit as we'll get into when we get into the slides here in a bit. But no new positions on for me today. I'm still long Delta. I've just been long Delta for weeks now, it feels like. But yeah, just staying the course. Every single thing in my portfolio closed green today, which is always a good feeling. I can never complain.
Nice.
Oh, holy cow, we're looking at my platform. Wow, we never have my platform. But anyway, yeah, everything closing green on the day. Ultimately a good day in the market for me. And yeah, I'm just kind of sitting on my hands and trying to decide if I actually think that this is the bottom or not. And especially with tariff news coming tomorrow, I was surprised to see the green day today. You know, generally the market doesn't care much for uncertainty, and today is one that's riddled with uncertainty. I thought about trying to get cute and maybe just getting short on some automakers right into the close or something like that, because I think that they'll probably wind up getting hit the hardest tomorrow. That's what the trickle down effect has seemed to be consistently throughout all this tariff uncertainty. But yeah, just sitting on my hands and waiting for the chop. Tomorrow should be a good, volatile, tradable day, primed for some day trades or maybe some fun things, get some positions opened. But we'll see. But I will say that a lot of what has been driving this downturn this entire time has been tariff uncertainty. It's been that these tariffs keep getting mentioned and the amounts keep getting changed, and the market has never had any certainty on what was going to happen. And so I hope that at least tomorrow, once we finally get all of the final tariff announcements, that we can begin to heal a little bit and move forward with certainty, whatever the certainty may be, but we will at least know what's coming. And I think that should help overall market health. So yeah, with my portfolio delta, as long as it is, you guys are not looking at one short position here. I could go through all of them. With my delta, as long as it is, I'm just hoping that we can survive the bleeding tomorrow and that things can recover quickly enough. The position that I'm concerned about the most is this QQQ, even though I'm still 90 DTE. 485 is my tolerable bottom there. And there was a moment yesterday, maybe, or today's Tuesday. So yesterday, where we were at 460, and I was like, man, if this gets down a little bit further, I'm really going to start to be worried about my 90-day time frame. Fortunately, things turned around, but no new additions.
No, I hear you. Long Delta. I mean, I hope we start seeing a little bit of a rally from here for the sake of some of my positions and for the sake of the position that we're going to pitch today. I know we can get into these slides too, and then we can head back to the platform if need be. But risk of the week, Gus. I know we were chopping it up a little bit about this. I'm excited. So we'll go ahead and break down these rules. If anybody wants to play along with us, feel free to do so. But we're going to start doing something called risk of the week, where Gus and I are going to put on a position. We're going to choose a ticker, give our case for it, and then move forward with that, come back and reevaluate those positions and so on and so forth. But I know the first one is you, Gus. Record 00. We got Gus at 00, Errol at 00. Let's get into our first one, Gus. We want to break down some of these some of these rules to start off.
Yeah, we can jump into a little rules here. So this is a little game we're going to play. Show's called Risk and Reward. The idea here is to try to acknowledge the fact that you can take some risk in the micro as long as it's a tolerable amount of risk within the size of your portfolio, and have a little fun. And it can be a very lucrative endeavor too. You know, sometimes it's fun to try to play the tails, and so we're going to be doing a lot of that here. So rules are pretty simple. We both must take one trade each week. And we'll do that on Tuesdays, I suppose, moving forward. Maybe that'll change. Maybe the day itself will change sometime. But we'll take one trade each week on Tuesdays. We're allowed to exit them at any time. That can be before expiration. We can let it expire at max profit should that opportunity present itself, however we choose to do that. The stipulations for keeping these trades risky is that nothing can be longer than 30 DTE, and risk must be objectively high or undefined. I'm not really going to put any constraints on that. You know if you're taking a weenie trade, you know. We're gonna keep records, and then at the end of each quarter, we will note the winner and loser. And there's going to be some kind of stakes to be determined. Maybe a friendly wager. Maybe the audience can decide on a punishment for the loser. Maybe just bragging rights. Not all too sure. But we are picking up at a very wonderful time right on the first day of Q2. So nice, easy transition into the quarterly contest. And yeah, that's what we got. So we can.
No, I'm looking forward to it. Yeah, punishment from the audience. As long as none of my boys from college are giving any advice on what the stakes should be, I think I'm good to go.
Yeah, but I felt that the punishment was going to resonate with the audience. I see that it is. We can talk about how exactly we want to do that later. But yeah, it'll be I don't know, no fantasy football style punishments, but we'll find something fun.
Have you seen those? Have you seen those? What is it? I don't know why I'm blanking. The football fantasy. What is it called? Fantasy football. Yeah. The football fantasy. Fantasy football. Have you seen the punishment that kids have had to do on things like TikTok or IG Reels to where they had lost in fantasy football and they have to do something crazy in front of the camera, in front of people or whatever it is? But people have been posting their punishments online, which I thought that was hilarious. It turned into a trend.
No, yeah, it is. It is crazy. And people will be crazy with them 24-hour challenges and Walmarts. Or the one that I like is you got to spend 24 hours in an IHOP and you get an hour off for every pancake that you eat. That's a fun one.
I love the stipulations.
Yeah, I think I could get 10 pancakes. I think that's about, I don't know, that's 14 hours.
10 an hour? What is that, 20?
I think I could do one pancake an hour for 12 hours. I think I could do that.
And you get an hour break.
You get an hour reduced off the total time every time you eat one. So if you ate 12 pancakes in 12 hours, yeah, I think that's doable.
I could definitely.
That's only 4 short stacks, you know. Anyway, all right. My pick for our opening session of risk of the week here is BitB, Bitcoin ETF. There's a few Bitcoin ETFs to choose from. Crypto is really beat down right now, so I'm hoping to. And you can see the specifics of my position here at the top. I just have one naked call expiring on April 17th, pretty short term, 16 DTE. I bought it at 46.35 spot price, and it was 5.10 a contract. I only have one contract because it's high risk. That's the whole freaking point. But anyway, crypto is really beat down, hoping for some breakout from this bearish channel. You guys can see my faint trend lines that I drew on there, and also my Ichimoku Cloud, the greatest technical analysis tool anyone's ever devised. Tariffs create uncertainty. We have tariff announcements coming up tomorrow, and so I'm hoping that there will maybe be some money flushed into Bitcoin. I've talked on this show before about how Bitcoin has started to behave like metals a little bit in times of uncertainty, where if people are uncertain about the US dollar, sometimes we find people turning to Bitcoin. It's happened progressively more and more each time that we have a little bit of uncertainty about the dollar, and so I'm hoping we may see some trickle-down effect from that. But ultimately, I think that crypto has just found a local bottom, at least for the time being. and that hopefully over the course of the next 2 weeks, this should be a nice little appreciator for me. But the final straw was Congress, which leads me into my next slide here. I keep up with Congress trading. I think I've mentioned tailing Nancy Pelosi on a few trades before. There was major action in Congress, well, at least in the reporting cycle over the course of the last week. Could I get a next slide? This man right here, Senator David McCormick. He's a Republican from Pennsylvania. He, I will say, ran this past election cycle on crypto. It was one of his main issues. So he is just partial to crypto in general. But these are the sweeps of this ETF that he has been buying over the course of the last month, beginning on February 27th with a 50K to 100K sweep. That's as specific as I can see because I don't pay the money. I don't pay the monthly subscription for the service that I use for this. So this is as specific as I can be. But 50K to 100K on February 27th. You can see everything that progressed there all the way through to 50K to 100K sweep on March 20th, just under 2 weeks ago. So that's 260,000 to 650,000 in this ETF in total in a month, bought in all these separate sweeps. And the man's net worth is $6.6 million. So we are talking 3 to 10% of this guy's net worth, which again is not liquid money. That's everything that you're worth. His house and cars and everything are included in that. So a considerable portion more of his liquid money he's been pouring into this. And I'm going to trust the efficient market hypothesis will say that perhaps he knows about something that's going to happen in the world of crypto that could really send Bitcoin through the roof here. So that's my angle.
I like it. I like this first pick. I gotta say, I'm pretty surprised by the crypto exposure off the first one, but I like it. I do like it.
I'm not
this is gonna be an interesting.
Not one to really ever trade crypto. I have my long-term holdings. It's not even a world that I keep up with a whole lot, but I know how to do technical analysis and I know how to look at what Congress is doing. So that's my entire basis here.
I had seen some posts earlier today. Did you see anything about BlackRock? And they were just making more statements about how they believe everything's going to be eventually, or is going to have the ability to be tokenized. I know we've talked a lot about tokenization across the network, and I know Ryan Grace, with the crypto segment's probably been doing a great job at explaining some of those fundamentals in terms of the tokenization of other asset classes too. But the CEO of BlackRock was talking all about that earlier today. I don't know if you picked up on that, Gus, but no, I know they're. I was just wondering if this was another reason why crypto was the decision for today, but I love it. And I also just love whenever I see, I'm not a big fan of BlackRock. I'm not a fan of BlackRock at all, if I'm being honest. But I do like when I see some of the bigger players in a specific space start heading more into a space that I'm interested or I would like to see a little bit more developed, like crypto and the tokenization of other assets. But just a little fact for the day.
Well, yeah, and in terms of tokenizing other assets, I do see that as being a very realistic thing in the future. I think NFTs were way too quick to the market, and that was sort of a dot-com bubble situation, a mini little bubble we had with the NFTs. But NFTs make sense for something like a concert ticket or a house deed or a car title. Things that you need to be non-fungible, one of a kind, and on the blockchain. That's a good application for it. But perhaps not buying a picture of an ape wearing a hat. I don't know that that's the best use of your money.
No, maybe not. And to the point you just made before we move on into the pick that I chose for today, I know with the NFTs, they were very early on, but we've seen a lot of, with the fact that most NFTs have gone down since the hype in 2020 and 2021, I still don't think that's a reason as to, NFTs were a scam. I think every single industry is going to have a level of bad players. And like you said, NFT was just ahead of its curve. But the idea of the NFT living on the blockchain and tokenizing an asset is very much so seems like what the future is going to seem like. I mean, whenever you're cutting out the middleman on big purchases, I think a long time ago, Kay and I did something on someone purchased or did some type of transaction with real estate through it. And you already know, especially the older individuals watching this, you probably dealt a lot with real estate, all the fees that go into closing costs, whatever it might be, and the middleman walks home with a bag. So I'm interested just to see how the tokenization works out in those asset classes too. But I love it. I love the crypto pick for the first one, guys. I love it.
Thank you. Yeah, we'll defer to you. I do want to give a shout out to Demi in chat who suggested spend an entire workday in Target wearing a red shirt. that sounds pretty.
Or a Walmart vest.
Yeah, you just gotta tell people you don't work there all day. That's funny. Yeah, khakis and a red shirt.
Oh yeah.
Go on.
But for the sake of your position, I hope the market does turn around. It does seem like crypto and the overall markets have a little bit of a correlation to them. But I did go with Old Faithful today, Gus. I went with Old Faithful, went with QQQ, but I'm going to be doing something different than I usually do on QQQ. I know if you guys tune in weekly, I'm typically selling out of the money put spreads or something directional on QQQ, or maybe a skewed iron condor sometimes. But today, what we're going to be going with, we're putting on a little bit more risk. We're going to be trading a zebra. I traded a zebra not too long ago. Again, this one was more pioneered by Liz and Jenny. If you want to check out more about the zebra strategy, it's all over YouTube, where they do a great job of breaking that down as well. But we're going to be selling an out of the money call. I'm sorry, we're going to be selling an at the money call, and then we're going to be buying 270 delta calls to get our delta near 100 delta. So this is going to be a synthetic stock position. So if QQQ moves up 1 point, I'll make $100. If it moves up 2 points, I'll make $200. It's a 1-to-1. If QQQ goes down 2 points, I'll be down $200. So that's the way we'll calculate the risk and reward on this trade. That's how I'll manage it. Very just like a stock position, but that's what I'm going to be going with. You know, the IVR is 38.4 on QQQ right now. Not that it matters too much with the position that I have on, because it is a 0 extrinsic back ratio. So it's not going to play too much of a role in my position, at least. And then you mentioned tariffs, right? I got tariffs. Got a lot of uncertainty. We're going to be putting this one on right in the morning, Gus. I will put this one on right as the market opens up tomorrow. Wanted to wait a little bit to April 2nd before throwing on the zebra. It's going to be a little bit more buying power on this one. I believe it's going to be around 3,000 of buying power all in, but still very much so cheaper than buying 100 shares of QQQ at this price level, because then that would cost around 40 grand, a little bit more than that. So very cost efficient, very directional. I don't think I've traded a zebra on an indice before. So I hope that the market keeps rallying. I hope that crypto rallies as well, because I think it'll help this position too. But before we shift gears here, QQQ's historic performance, the 12-month return over the trailing 12 months ending March 31st, 2025, QQQ had a return of 6.2%, showing a lot of resilience on the longer time frame. So we know positive drift, one of Dr. Jim's favorite topics to talk about. So although I am long, putting on a zebra position can still be risky per se, which fits for the segment title. Can still be a little risky because it's a large position, you know, and the market can go down another 5% before it wants to rebound. But another thing I did have on the last slide was the fact that we're down 12.5% from the all-time highs. So it seems like we're in correction territory. Another leg down seems like it would send the volatility index above 30, but another leg up would seem nothing less than a relief rally that we've all kind of been waiting for. So I went with QQQ, I went with the zebra, and then again, we've had a 5-day decline in the last 5 trading days of March. QQQ declined 4.68%, reflecting a very bearish, short-term sentiment, probably again having a lot to do with the tariffs that are floating above our heads right now. But we've been absolutely beaten down. So I had an assumption we were both probably going to come in long today, but again, had to go with QQQ. Gus, what are your thoughts on this?
Yeah, I like it. I think it's a great way to get some leverage, and I think it kind of exemplifies the whole point of what we're trying to illustrate here is that you have managed to take on all of the risk and all of the reward of 100 shares of QQQ for about 8% of the cost of 100 shares of QQQ. So yeah, I like it a lot. I'm a big fan of the zebra. I can't, like we said, go talk to Liz and Jenny. I don't know how to do a naked put dance. They're the pioneers. But yeah, I like this a lot. I think it's a fun one, and I totally agree with your sentiment. What time frame are you thinking again?
So this one, I'm going to do I recognize you did the April 17th as well, which I'm probably going to do too, because again, of the buying power. The closer expiration date that I have, it'll be a little cheaper for me to put this one on too. So I'm going to be looking to manage this one fairly quickly. But this is what we were talking about earlier in the slides, selling that at the money. I like to go just one right outside of the money, technically at the money, but the one sitting right outside of the money, and then buying 2 of the 70 deltas. And then right here, that brings us to about 90 positive deltas. So it would be plus or minus $90 on a point move up or a point move down. So that's what we're going to be looking at tomorrow. Same cycle though. I wanted to keep it in the same time frame so that we can manage those efficiently together.
Yeah. I think, and I think that's a fun way to do it. And I think that it's wise to, even though it's kind of cheating, I think that it's wise to wait until tomorrow, because if we, I know. When I saw your position, too, I was like, man. But okay, but I gotta say, if I was gonna put this on, I technically would be up
Probably a few $100 if I did put it on earlier today. We got some random rally towards the last hour of the day. So in hindsight, I do wish I would have put the position on because I would have had a better cost basis.
I would add too that the show is called Risk and Reward, not Take Idiotic Risks. And there is a fairly, there is a sizable chance that we see a little bit of red off of open tomorrow morning. I'm really just hacking on you. I would have weighted it as well, but I'm actually trying to maybe farm some of the uncertainty that tomorrow morning could bring. So it's just two different angles.
Hey, how so? What do you mean by that? What do you mean by that when you say farm that a little bit?
I think that there is just this trickle-down sort of sentiment effect that happens even when these moves don't necessarily pertain to the U.S. dollar, and tariffs do have indirect correlation with the U.S. dollar as well. But I just think that we are going to see increasingly more, and I'm really talking in a very macro context here, and this is a very micro trade, but I think that we're going to see increasingly more in times of market downturn or general uncertainty. People are going to want to turn to cryptos, which are stable and, have the same buying power across the world, to a relative extent, especially once you can directly spend them. That will be the case. And more so, I should say. I understand you can buy a pizza with Bitcoin if you want to now. But I'm just hoping that uncertainty will flush people to, I don't want to say non-financial, but more assets with backing, with tangible value. And I think that Bitcoin is going to start to emerge the same way that metals do in those sorts of situations. So, that's sort of my thought.
Are you of the proponent that, didn't mean to cut you off, are you the proponent of that Bitcoin and crypto could kind of be the new gold standard? I say that lightly.
Yeah, I would say so to an extent. Because Bitcoin does check all the boxes of an actual asset in the same way that gold does, and it holds value simply because of scarcity and for being what it is in the same way that gold does. So I think that there is a lot of parallels to be had there. Like I said, obviously this is a very micro thing, but I think that 10, 15 years from now, Bitcoin will start moving closer in line with gold and silver and copper than it will with the rest of the market, which is unlike how it is now. Take Idiotic Risks is a great name for a new show. It could be the Jackass of trading shows. That wasn't even the host. Jackass. They weren't even taking risks. They were taking certain injury in most of those.
They knew the outcome. They knew the risks they was taking on. But no, I love that overall with Bitcoin and crypto. Again, with the uncertainty with the tariffs coming up, that's really just what my eyes been on for the rest of this week. So tomorrow's going to be an exciting day. April 2nd, it's going to be Wednesday, third day of the trading week this week, and we get a little bit of a resolution when it comes down to the tariffs and uncertainty. Yes, I don't know anybody else, but I could tell. There's been a shift in just the overall sentiment whenever the conversations between Canada and Mexico in terms of tariffs were going on late January, early February. So until then, we'll see if we get some more closure tomorrow.
Politics aside, I just want the certainty. I just wish we would just do something. I don't really even care what it is, but I just want to be done with the market trading the way uncertain markets do and slowly making its way down because we don't have anything definite on this yet.
I hear you. And it really is bittersweet because if we do get that pop in both of the assets that we're in right now, if we get that pop, we're probably going to send it under 20 on the volatility index, and it's bittersweet. It's going to work out for those positions, but at the same time, I'm going to be like, man, we're falling below 20 on the volatility index again. But again, I'll take what I can get. Market's down 12.5 from the highs, even though I am still bearish right now, the way we've sold off and how far we've sold off, I'm a little bit bullish. So nonetheless, we'll see what we get.
Yeah, I'm bearish just tomorrow. I think that my
Are you bearish tomorrow?
I think my bearish sentiment will begin to end tomorrow. Well, because after tomorrow, I think that there will be certainty, and then at least we have that box checked, and that things can start to work themselves out. But I just think that whoever is most affected by these tariffs is going to get torn down a considerable amount tomorrow, and then it'll probably be too much for the rest of the market to sustain. I expect bleed out of the open. I haven't traded on that sentiment, but I do expect it.
No, I hear you. Again, I was taking a look earlier at Meta and Apple and those kind of underlyings as well. But I'm still in a little bit of a pickle on these ones, Gus, right? We're down a little bit on DraftKings. Meta, That one had returned a little bit, and then we continued to sell off. But if we get a rally within the next week or two, those should be able to recover. Those are the April 17th expiration, the same expiration that Gus and I are putting on for these two positions. And then again, got Old Faithful in there, QQQ. Have another out of the money put spread that I sold on there. Those are all in the money. And we're at 485 put sold on QQQ. And let's just get a quick visual on where at least need QQQ.
You also need 485? Shoot,
I do.
I need 485.
Is that 480? I do need 485. You have 90 days on that, though, right?
I do. Yeah. If we hit 485 by your expiration, I think we should.
Are you
hit
out
it
with
by
me?
Mine. What's up? Am I out with
me if we get 4?
No.
Yeah, if we hit 485.
Heavens no. I think I would, well, that wouldn't be about break even. That would put me considerably up. But no, I'll let this one ride. I mean, QQQ, and I have an NVIDIA position that's the same expiration. I took those just kind of like when all this downturn, when we were about halfway through what this downturn has now become, just because it was just broader long-term rebound sentiment things. I mean, like you just said, drifting upwards. And yeah, I think that'll prevail. But NVIDIA, I only need above 100. I got plenty of room on NVIDIA.
No, I hear you. It's just all these underlyings look the same. I thought I just clicked on Meta. I thought I just clicked on Apple. I thought I just clicked on QQQ. All of these underlyings look like they've been moving very, very similarly. It looks like they're all correlated. So anything else to add before we wrap today, Gus? I'm excited about it. We'll get on that QQQ position. It'll be a zebra. I'm going to have to keep a close eye on that one again because it is like a synthetic stock position. But other than that, anything to add?
Yeah, kicking myself, feeling like I should have gotten long VIX before close. So that's how I'm feeling. We'll see if I FOMO chuck myself into that tomorrow morning, but I think it'll probably already be too late. And Mike,
you think we gap down tomorrow?
Mike made me laugh here with the. There still won't be any certainty. He'll announce the concept of a tariff plan to be disclosed in 2 weeks. Yeah, that is also a option that's on the table for sure. But yeah, I mean, I feel like even if I'm incorrect about my sentiment that we might move downward tomorrow, what will definitely happen is volatility. So that's I feel like long VIX is always a good way to if you know that the seas are about to get rough and you don't know how your boat's going to fare, VIX is an airplane over the ocean. You're good.
We'll see what we get tomorrow. We'll get these positions on, and then again on Thursday we'll wrap back around here and check those positions out. But other than that, we'll get these positions on. We have some resolution on the tariffs coming tomorrow, so be sure to look out for that. We'll keep an eye on VIX and the rest of our positions. But other than that, guys, thanks for taking the time to hang out with us. We'll give an update on these positions and how the risk and reward is going, and that's going to wrap it up for today's segment. Be sure to stay tuned for more segments coming on next. We'll catch you guys next time. Peace.
If you missed the live show, here's our cherry on top weekly recap.
First of all, I'm sitting in the captain seat. I've never been invited to come sit in the new captain seat. But what I'm concerned with is the size of these screens. And then he's still doing this.
Snow, let's take a look.
They did not hold that rally at all.
Phil, you got a partial. 973.75.
I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could like swivel his head. He has to see the screen. He has to go like this to me. And then you know what? Money goes to money. You did it. Good job out of you.
Yeah.
I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
If you missed the live show, here's our cherry on top weekly recap.
I had what you call the hot girls dinner.
Oh, you had girl dinner.
Cheese plate?
No.
Popcorn and wine?
Crackers?
I went snorkeling.
You went snorkeling?
But I said the last time I went snorkeling.
And the fact that you've ever been snorkeling is pretty amazing.
That it also implies a future time that you will be snorkeling, right? Not because you didn't say the only time I went snorkeling. You said the last.
The last time. It kind of has the implication.
What did you say? The fact that I've ever been snorkeling is amazing?
Yeah.
Why?
Because she studies physics and it's not supposed to work.
It just doesn't, yeah.
Wait, you're going to Vegas?
I am going to Vegas, yeah.
Ooh, for what? For just funsies?
For my birthday.
Oh, wait, I didn't know it was your birthday this weekend?
Yeah.
Oh, happy birthday.
There you go.
I didn't know you were an Aries.
I am an Aries.
Yeah, that kind of tracks.
Something. What is your sign?
I'm an Aquarius.
Aquarius?
I'm an Aquarius, yeah. Tom's a Pisces.
Pisces.
Yeah.
That makes a lot of sense,
It does.
Yeah.
It really does.
They kind of track.
I don't even know what that means. Sure. Whatever.
I think it means you like fish.
What happened, girl, during last call?
I lost my
You want to talk about it?
I lost my beret.
You didn't lose it.
I found it.
So you got...
I'm thinking of getting rid of it.
Oh, new look?
I'm thinking of the new look.
You should do a faux hawk.
Oh.
What is
I think you nailed it. I don't know.
No. Cornrows.
I could see rocking some cornrows.
Yes, cornrows.
I think you should go to Flavortown and just get the Guy Fieri spikes.
Boom. Platinum tips.
Platinum, yep.
Is it true? Did you skip the beret yesterday?
On the clothes.
Oh, it looked like it looked like a decrepit old grandmother. It was so gross.
It's like that old monster from Tales from the Crypt.
Get the full scoop by checking out the archives at tastylive.com.
We just ripped higher up to 50 points, and I just thought we would stay there, but...
The thing the market does best is it keeps you very humble.
You get paid a lot for being right, and you lose a lot for being wrong.
So give me, I don't know, a couple hours, and I will give you everything that you need to start trading options. See you inside.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
Oh, yeah, it is Tuesday, April 1st, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. It is Tuesday, everybody. You know what that means. We got the big brain with us. I'm talking about the one, the only, the global head of macro here at Tasty Live, Mr. Ilya Spivak. Ilya, how you doing, my friend?
Good. Getting ready for what is sure to be an exciting week. It's been fun for those of us that like macro. It's a juicy week for all things macro. So I'm just reveling in all of it.
It is a juicy week for sure. I'm 14 hours ahead over here. So you asked me, it's kind of a funny thing when we were in the green room. You said, you asked me, since it's already Liberation Day for me, how do I feel? Mm-hmm. And I must say, man, I've never felt more liberated. I feel very liberated. It's a great
Tremendous.
feeling.
I mean, a trade hub like Singapore is certainly on the front lines of what we could be seeing.
Yeah. Yes. More on that in just a bit. But before we get to all that, we should probably say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile apps. If you don't already have them, go get them. But if you want to be part of this little chat in the middle of your screen, there's only one place to do it, and that's over on Tasty Live's YouTube channel. So head on over there, jump in the chat, start smashing your metacarpals, your phalanges, and even your skull into the keyboard. Type random ass characters if you have to. Just make sure you say something. That way we can spoof the Google algorithm into putting us in front of as many people as possible. Shout out to everybody in the chat. I would shout you out, but we got the big brain with us, so we're going to utilize it as much as possible. Ilya Spivak, a little bit of a bounce here today. Markets don't go in a straight line anywhere. And acting like it has nowhere to go in a hurry. The S&P up about 2/5%, the NASDAQ up 4/5%, the Dow Jones did nothing, which sort of makes sense. It's been sort of this low beta, low vol refuge. So in a world where there's a bit of risk taking, you might expect the NASDAQ to outperform, especially with the Mag 7 sitting at support, people starting to take some stabs at risk there. And the Russell was up 2 basis points, not much. Your take on a little bit of risk taking to start out a new month and a new quarter?
I don't think it's anything that one wouldn't expect. I also don't think it's anything to hang your hat on if you're of a bullish disposition, because I think the bottom line here is that when you look at what's happened in both the S&P and NASDAQ, you might be more so encouraged, let's say, by the S&P because it's come down to retest its low from middle of March, where it landed after those 4 weeks of brutal selling, and didn't break the low and has bounced a little bit. NASDAQ, on the other hand, did break the low. And what this bounce has done is marked a retest, not a taking back over of that breach. And so while you might have sort of Russell stalling at what looks like could be support, S&P stalling, the NASDAQ has actually broken down. And for it, the situation is doubly bad because, of course, the essence of all of this rally, really since it started in late 2022, has been tech and NASDAQ focused. So if the NASDAQ, positioning-wise, looks like the limpest of the bunch, that's probably not good news for overall market positioning. And you probably have more like the markets evening out and retracing on what was the sell-off last week into this big news that we have in the back half of this week, be it the big tariff announcement, such as it might be tomorrow. I'm sure we're going to get to the contours of uncertainty as to what actually will be announced and what won't be in a second, but there's some kind of announcement that's coming. And then, of course, at the end of the week, we have U.S. jobs data, and Powell is speaking. So this looks more like the markets got very defensive on Friday, the last kind of Friday before quarter end, and we have a little bit of kind of rebalancing of the books going into the event risk, but I don't think there's anything about any of this that seems constructive, and I think the NASDAQ might be the canary in the coal mine.
Maybe. Let me ask you this question. Why exactly should I be nervous about digital or social media companies in a world of tariffs on goods?
I think the greatest insight in this entire sell-off has been to understand why the markets have decided to become afraid of tariffs when they knew about them in November and before. And the reason is there is a fundamental difference between knowing that there is an idea of these tariffs and sort of saying, okay, well, this wasn't really a problem last time. There was tariffs last time. Biden didn't undo any of the tariffs. No one died. In fact, the Biden administration was even more tariff inclined than Trump administration version 1. So, okay, should we really be that afraid? And the markets rightly didn't panic. Nobody was surprised that this administration would pursue tariffs. Nobody was surprised that we were going to have a move to reduce the size of government and reduce fiscal outlays and somehow then try to balance that with tax cuts. There's no shock in any of that. This was well known. And again, November is the latest you should have known it, because by then the election was done and now you really had confirmation that all these things that the president had been talking about endlessly on the campaign would now have some sort of a path forward. Now, the problem becomes when the survey data on business confidence starts to tell you, never mind the substance, that the uncertainty around what this stuff actually means in practice and the inability to then plan ahead is becoming a cooling force on economic activity. And the place where people really start to freak out is when that shows up in the service sector, not manufacturing. Tariffs target manufacturing. That is the goods side of the ledger. But when sentiment starts to erode in services, and you start to see it with S&P Global PMI data in January, and from there, it starts to show up in more areas. That was just the first one that really popped up. And S&P Global is often early on these things just by virtue of how their release cycle works and who they pull and when. But they were the first to really start to show this. And since then, it's shown up in consumer confidence data for several months, different publishers. It's shown up now in the ISM data as well, different business confidence publishers. Obviously, the Atlanta GDP Now numbers, forget what they're actually saying. The level is meaningless this early in the game. But it tells you the direction of travel in the data, and that's obviously down. So you're seeing it elsewhere. The problem isn't, again, the tariffs. The problem is that whatever atmospherics have been created are getting businesses to retrench on spending until greater certainty arrives. And you care much less about it if it's manufacturing. That's a smaller part of the economy. And it's been anemic before this, all through the second half of last year. You care about it when that sentiment negativity infects services, because that becomes a much bigger issue. That's why software companies care about it. That's why all of this matters so much. Because if companies stop laying out capital because they can't make inventory the decisions, and or at least they feel like they can't, and they can't make the decisions on staffing, on investment, capital outlays of every kind, and against that backdrop, economic activity slows significantly. That's more than just the one-time price adjustment for manufactured stuff that the tariffs could have been or maybe were intended to be. This becomes a very different thing.
I don't buy any of that. I don't buy.
I mean, you don't have to buy it. It's in.
Yeah, I just don't. I don't buy any of this stuff. And so some part of me just wants to. Some part of me just wants to start buying up NASDAQ, and I think you get on the other side of April. So some weird part of me thinks we rip like 2.5-3% on the other side of this.
What it is that you think that isn't credible. And I don't mean the end result. I mean the analysis of what's happening here. Do we agree that the surveys broadly
of course.
say what they say, and that the market is responding to what they say in a negative fashion?
Yes. So I agree. So the most powerful part of what you said was at the very beginning when you said the markets, any savvy market participant,
of course,
had a baseline that everything that's unfolding right now is in the cards. I mean, you have to know that this is coming.
And not
November.
Savvy also. I mean, you just have to watch the evening news, as it were. You know what's going on.
You knew tariffs were going to come. You knew a new trade war was going to come. You knew that was going to bring volatility. You knew that you knew a bunch of this stuff in November. I think that's the most powerful thing you said.
Of course. I think you had to know. Markets had to know.
I'm not denying what is in front of my face, which is volatility and uncertainty. I'm just not. There's some part of me that just doesn't see this as this big tariff scare. And if that's what it is, I'm telling you, if that honestly is what it is, you buy everything in front of you, I think.
I don't think it's a tariff
you buy every
scare.
cheap asset. I don't either.
I think the fact that people knew in November that the tariffs were coming means it's not a tariff scare.
Correct. So then you and I are on the same page. I believe that the hard data is showing decelerating growth. But I also, again, I think you and I had conversations at the end of last year, and we would have been saying the same exact thing, that things are decelerating. And honestly, I think even you would have said things are slower than they appear in the data. And now the data is showing up. Yes. I think there's a big dumb impulse with managing a bunch of Bitcoin. I understand that these tech stocks are a bit too expensive. They were a bit too expensive. The valuations were insane. Price to sales and some of this stuff was dumb. I understand that the market has only corrected 5%, but a lot of those Mag 7s have gotten just obliterated in a pretty decent. They're either in correction territory and some bear market territory. And I'm going, all right, if we're taxing champagne or whatever, how does that actually impact?
Well, and so this
Facebook?
Is the thing. So this is exactly what I'm saying.
Plus, one more thing added on. I don't think it does to the extent that I don't think it does to the extent that it's being thrown into this narrative. And then the other thing is, I look at the curve now. I look at the implied odds of cuts, which have now moved to a solid 3 within the year. That we start cutting in June.
73 basis points. You might as well say 75.
We start cutting in June, we get another in July, and they've even moved up to third. It used to be flirting in December. Now it's like, no, you're going to get your third in October. Yeah. And so I'm thinking, okay, so we're about to start another cutting cycle of 75 basis points of the coming months. These things have already haircut 15 to 20%. And the tariff war is on raw goods. Why should I be afraid to step in and start looking at risk in some of the technology companies?
This is the key. If you are looking at this and saying, why should you care about the tariffs won't impact Facebook's bottom line in terms of how Facebook operates and sort of what their cost structures are, what they pay for, what they don't pay for, what the knock-on effects are, your argument makes perfect sense. What I am trying to show here is the reason that the market sold off when they did and not in November is because the atmospherics of policy uncertainty have infected places not immediately impacted by the policy. And that's what the business confidence shows, that people are looking at the way the policy is rolling out, and they're saying, we are not going to deploy capital in this environment. Not because the tariffs impact them themselves. This is why this is not a tariff scare. People knew about the tariffs in November. What they didn't know was this. They didn't know the deployment. They didn't have a question about, do we have confidence in other policies or just general management of everything, be it the fiscal retrenchment piece with the tax cuts piece, be it whatever else. The markets are looking at how this rollout, these first few months are being internalized by business leaders and consumers, and it happens to be tariff policy first. It could have been something else, I think.
Yeah, I just think it's convenient. I think it's very convenient. I think the Fed is stuck in a box. I think it's easy for them to start, tariffs are creating uncertainty and all this other stuff.
Are you suggesting business leaders aren't saying what they're saying?
I think it becomes a convenient way for a bunch of business leaders to shed excess labor without being blamed for being greedy or whatever. I think this is a very convenient narrative for a bunch of operators. I think what happens likely is if people start shedding employment, I think they gave a really grim look of what the next 3 months look like when we get into earnings season. And I think ultimately what happens, man, is they set the bar so low on the floor that it's really easy to jump over a credit card. And I think the reality of the next quarter earnings, once we find out what the actual earnings are going to be much, much, much better than what the current low expectations are. So I'm not disagreeing necessarily with your framing of how to think about it. What I'm doing is trying to think through how are people perceiving the future, and where do I think they are potentially wrong, and where do I think that I might be able to take some
something
risk?
Yes.
Yeah, go ahead.
Here I think there is something. You're right. So here I think there is something. And to sort of get to the crux of it, whether you want to, I don't question CEOs that say in their earnings calls and in the polling for these surveys, where, by the way, they're not named individually, so they can be honest. Nobody says, this company said this in the PMI survey or the ISM survey or anything like that. So they can be candid, because after all, they do want these surveys to go into the hands of policymakers and for those policymakers to then give them lower rates, because whether they give them lower rates for ultimately good reasons or bad reasons for everyone, companies want them. So there's benefit in saying you're having issues if you have issues. So that is just pure self-interest and commercial benefit. So I take them at face value when I look at these business confidence surveys. I don't think anybody's shading anything. And I would say, whatever the reason, whether it's an excuse or it's not an excuse, whether you want to blame the tariffs or blame something else, the bottom line is people are going to see job losses, and inflation expectations are going to lead to higher prices, and that's going to squeeze people and squeeze the economy to some extent. And then we'll see if the Fed can counter that. And from a sentiment perspective, that doesn't mean the market can't go up, because the market can absolutely go up in bad economic times if people perceive value.
So to your point, likely the Fed has a couple of levers, right? They already decreased the size of QT. At some point, they can pull us out of it altogether. We've also priced in, nearly 75 basis points of cuts.
Yeah.
And that changes the value of money. That changes the net present value of future cash flows.
Yes.
And so I start to think about those things. Plus, if you're going to let people go in the short term, what that means is your margins are going to expand, right? Especially for like a technology company, right? There's less expenses going out of the door. And so some part of me goes, longer term, those people are not going to be spending money in the economy, and that will create some pressure. Shorter term, if people start shedding their employment base or their employees, and you're going to get a movement in rates, I'm just trying to understand why.
Well, so let's go even shorter term.
Go ahead. Why exactly shouldn't I be taking risk here, given the setup?
I think you're right. I think you're right to be sniffing around in this area, because this really is how tomorrow ends up going in everybody's face if this is what happens. And I want to underscore the if. I am not going to question CEOs because, again, it is in their self-serving interest to be honest that there is uncertainty if there is uncertainty, and to be honest that they would like relief if they would like relief. They have no reason to cry wolf if there is no reason to cry wolf, because they actually do want the policy support. They're self-interested in it. And so, because they want lower rates, they have tons of debt to refinance this year, they want an excuse to lay off expensive workers and pad their margins. We know that all of the inflation has been stuck in core services, largely because of labor hired in the initial opening phases of COVID at very, very expensive salaries. We know that's the case, not just in the US, but in Europe and everywhere else. So sure, okay, let's say that all of this is sort of the blaming of the tariffs is window dressing for corporate retrenchment, but that doesn't matter because the corporate retrenchment is coming anyway. Okay, fine. So the essence of tomorrow's announcement then hinges on what it means for uncertainty. If what comes out tomorrow, branding, Liberation Day, blah, 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 is the grand plan, that then everybody can say, all right, here is something that gives us the architecture or the infrastructure of something that we can extrapolate forward. And on the basis of this, build expectations. Well, then I think the stock market actually likes it, even if it's ultimately a growth negative, inflationary maybe, economically spooky maybe kind of outcome. And you might have a situation where everybody in the kind of political media runs around ripping their hair out or cheering it, depending on which side. And all of that is noise, but the markets ultimately look and go, okay, so the problem wasn't the tariffs, it was uncertainty about implementation of fiscal policy. You've shown us that the uncertainty, at least in this thing that we've been using as an avatar for general uncertainty, the tariff thing, that you've addressed it, right? Because markets don't care good outcome, bad outcome. Markets care forecastable or not forecastable. And if it's forecastable, not predictable, nothing is predictable. Nobody can tell the future, but forecastable within some reasonable way to extrapolate so that businesses can say, here are my inventory expectations, here's my staffing expectations, here's my investment expectations. This gives me a framework to do all of those things. If that's what comes out tomorrow, stocks rally. And bonds probably rally as well, because all of it probably still means more rate cuts. But if the clarity doesn't come, and by the way, if the tariffs are a negotiating tactic, there can be no clarity because no offer is the final offer.
Yes. What you just said, so you know what's interesting? I've had these two thoughts that like everyone keeps using, I think old mental models. I'm gonna give you two thoughts and then something to chew on, and I want to hear you kind of wrestle with in front of the public here. One is, I keep hearing this old trope, right? Markets don't like uncertainty. I can't tell you how many times I've heard this stupid fucking saying on everything I turn on. You watch Bloomberg, you watch CNBC, you read an article, it's like everybody's saying this stupid saying. It's like, thank you very much for your wisdom. Like,
well, nobody can tell the future, so define uncertainty. Like regular uncertainty or more uncertainty or less uncertainty. There's no crystal ball that exists in life.
It's like saying I'm cautiously optimistic. You know what I mean? It's like the stupidest saying. That's basically saying that there's positive drift in the world and in the market. Anyways, what is certain about this administration is there will be uncertainty. There will be greater levels of uncertainty, greater levels of potential distribution, is because I think they have a desired outcome, but I do not think they have they have not mapped out the path, because they know that in each of these negotiations, it could go this way or that way. So they have an outcome, but not a desired path. And with that comes lots of uncertainty into how or where we get to their ultimate desired outcome. So I think,
I'm not even sure we have the desired outcome, because what does reciprocal tariffs mean?
I think. Hold on. This isn't even the one.
Yeah,
this isn't even the most interesting part. I don't think.
Sure.
So. And I also think in the first administration, this goes to the idea of reflexivity. In the first administration, what did we learn or teach each other? I don't say teach each other. What did we learn? We learned that he would say something crazy, but that actually was 2 times more than what he was actually aiming for. The markets would overreact.
Sure.
And by the end of the 4 years, what the markets stopped doing was overreacting to the literal interpretation of what he said. The most interesting thing about this second administration, the second run, I think the markets are doing the opposite. So what's happening is he's saying something and the markets are going, oh, he doesn't mean that. And so you're getting a muted response to, I think, some of his proclamations. And that ultimately means he's going further. You know what I mean? He's going further. Like at the beginning, it was tariffs are a negotiation tactic. And now we're like, all right, I think he means 20% tariffs across the board, or he's going to do only 9%. And he's like, oh, no, I'm doing blanket tariffs on 20% across with no exceptions. It's like, Jesus Christ, this guy was serious. And he's going further because the market is really not giving the literal interpretation enough credit. Do you get what I'm saying?
Well, and maybe, of course, and I mean, it's very insightful, and I think people should be paying attention to this, because I think it ultimately dovetails with where I'm going here. You don't need to have a good outcome. First of all, to say that markets hate uncertainty, you kind of have to thread this a little bit. Anytime somebody says that, you hope what they're saying is the markets hate more than the usual uncertainty or an absence of forecastability, because there's always uncertainty. Nobody knows the future at all times. Really, all you're dealing with is probability distributions and trying to guess in an educated way to where if you lose, you don't lose more than you gain if you gain. And to keep doing that over and over again. It's the same thing that we as investors do, as traders do. Nobody says you're never going to lose money. Everybody that is participating in markets should expect to lose money sometimes. And the goal isn't
No,
not
I
to
actually
do that.
think it's the wrong model. I think it's a stupid. I'm a market participant, Ilya. I love uncertainty. Uncertainty
Of course you do.
brings opportunity for me. I like vol because vol, the inverse of risk is reward. The higher the level of uncertainty, the more potential there is for higher returns within a smaller period of time. I'm actually telling you, I think it's a stupid thing to say, and it's said by people that don't truly understand market participation. I'm telling you, I think it's a bad mental model.
So this is why when I talk about it, first of all, I'm not talking about markets. I'm talking about business leaders whose thought process is different. If you're running a factory,
completely different. Sure.
If you're running a factory, it's a different conversation.
Agreed.
What I'm talking
100%.
about is the lack of forecastability. What the markets don't like is when they can't make heads or tails on something. If the markets can have a forecast, and then they can trade the forecast, and then data comes out and then creates volatility in the forecast. I mean, sure, yes. If you're a business leader, you at least want to be able to say the rules of the road for the next 12 months are going to be X. Within that, I need to do Y. And I think that's what people are talking about. But
I could still make the case. I know this is I get what you're trying to say. I could still make the case that a wise, a clever business leader likes uncertainty just as much, because that gives them the opportunity to increase market share by buying a competitor or vertically integrate or horizontally integrate.
Not if you're
business.
a maker of washer machines and the uncertainty is the price of steel. So
yeah, I would say it depends on what where the vol is coming from. I would agree with you.
The question is, can you forecast your business so that you can make all these savvy decisions? And so again, you're not afraid of things looking adverse. You just want to know how to lean where the wind is blowing, to lean with it, and to extract what you can. And for that, you need some kind of reasonable window to look forward with some confidence as to where the wind would blow so that you could go there. And so I think that's the issue. And to the extent that this announcement tomorrow appears to create a sense that there is a sense of which way the wind is blowing, I think risk likes it. But the bottom line is you still need rate cuts. And the bottom line is you still need accommodation. So I think what you walk away with tomorrow is either stocks like it or don't like it. But bonds like it.
Yeah, of course.
And so from a trading perspective, I think that's ultimately where this goes. If the object of the game, as you're saying, is precisely on the part of the administration to create more uncertainty and to use the falling stock market as the inducement for people to come and do deals with you, then it's the strategy. It's not a bug, it's a feature. You come out and you scare everybody half to death, and then they have to come and do deals with you. Or, for example, you deliver a reciprocal tariff scare so that countries go, you know what I'm going to do? I'm going to lower tariffs on the U.S. That way, there is no reciprocal tariff increase coming my way. And the result is to create a kind of shadow WTO, where instead of everybody coming into a WTO and saying, we're going to give everybody our best tariff deal that's in the WTO, you say, the U.S. is the WTO. No more artifice of multilateral agreement. We run this. And what ultimately happens is actually a broader decline in tariff barriers, because everybody says, I don't want reciprocal tariffs, so I'm going to lower tariffs. Then the reciprocal tariffs go down. Then everybody's tariffs go down. You end up with less trade barrier, not more. Possible. Markets could certainly appreciate that and could certainly be confounded by the strategy now and on purpose, because it doesn't work if they're not. You have to first scare everybody half to death to achieve this. And basically to say what the end goal is more free trade, not less, which would jive with what seems to be occurring with the USMCA and the Canada and Mexico kerfuffle. And that what really is occurring is a shifting of international trade policy power from WTO, the U.S., but obstructed, to just the U.S. openly. And saying, the U.S. just runs this now. The WTO is an afterthought. This is the new regime. Good night. That doesn't necessarily mean less free trade. It could mean more. So, and to achieve it, you would need to scare everyone into compliance. So maybe that's the plan all along. Fine, whatever, sure. But in either case, whether this is coherent or incoherent, whether the goals are known or not known, whether this is a brilliant tactician playing 4D chess, or this is erratic malpractice of fiscal policy, doesn't really matter. Either way, you need lower rates and higher bonds.
I don't know. I agree. Put it this way. I agree with everything you said. I think there are a bunch of other factors that we could now throw in as to what would be the offsetting. Like why do you think bonds have not moved from basically 117 plus or minus a point?
I think they've been up all year. They've been rallying all year.
I guess what I'm saying is, given the recent equity volatility, bonds have
shot up back to the highs. Stocks are basically back to where they were in early March, and so are bonds. Stocks have reversed their bounce. Bonds have reversed their pullback. We're basically back to the early March starting line.
Right. Okay. I guess, I trade bonds a lot, and I guess a couple of points in one direction in ZB isn't like a really
but I mean,
really gone anywhere.
It's a slower
opinion.
market than stocks, of course. But the architecture
but
of what's going on is the same.
The through line in bonds has been basically 117 throughout all of this volatility, plus or minus a point. And plus or minus a point is not really going very far in the bond world. So I guess my question is, what do you as gold is making new all-time highs each and every day, bonds effectively, given this volatility, have stayed relatively muted. In my personal opinion, you seem to disagree with that characterization. That's fine. But let's just both agree that bonds aren't exactly doing what gold has been doing for the month of March. I think that's a fair assessment.
I don't think anything is doing what gold is doing.
That's very true. Why do you think that there is such a demand for gold as a risk-off asset in the month of March versus bonds? Why do you think that is?
I don't think that it is demand for gold as a risk-off asset.
Okay.
I don't think gold is a risk-off asset. I think what we're seeing is building speculation that rates are going to come down. And when you look at what that looks like in the bond market and in the dollar, you see it play out directionally in the same way. So since the beginning of the year, you see all of this occurring in tandem. Now, where does gold begin its most recent rally? It begins it in the second half of February into the beginning of March, where at that stage, you've already seen the move in stocks. You've already seen the move in bonds. And gold is kind of, it moved earlier before, then paused earlier, then everything else moved. Now gold moved again. Gold is not really moving in a way that's directly connected with what's going on in stocks and bonds. Stocks and bonds are kind of, and to some extent the dollar, are kind of mirroring each other's dynamics. Obviously, there's different liquidity. Whether you look at the front end of the curve or the back end of the curve impacts how much impact all of this is having. So, of course, you look out to ZB, it's not exactly showing you what, let's say, Fed funds futures or SOFR rates are showing you. Fed funds futures look exactly like the S&P. I mean, you look at the Z5 contract December, where Fed funds futures price in Fed rates by the end of the year, and you can look it up on the platform. SR3Z5 is the 3-month SOFR, which is basically the same thing, and you can see that it looks pretty much exactly like the S&P, and gives you the same dynamic. So look at that pull up, then slight correction, now back to the place where the pull up ended. Does that not look exactly like the S&P upside down? So you're seeing it. What gold is doing seems to be this kind of, it's difficult to say that it's even a haven per se, because you're not seeing the same thing in other kind of anti-fiat, anti-rate proxies. For example, Bitcoin.
I'd argue the fact that it's hanging around in a tight range, 80 to 90, it's showing relative strength for an asset that typically is highly correlated to the NASDAQ. So I'd argue that, yes, it's not showing the same upside, but for a highly correlated NASDAQ instrument that has just stuck at 84 or 85, given everything else taking a haircut, I'd argue that's pretty decent performance, all things considered.
I mean, maybe. I think we have to. I mean, you're saying it's hanging out, but I would say that there was a peak in Bitcoin at the end of January 21st specifically. And since then, you've gone down 30%. So I don't know. I mean, for Bitcoin, obviously 30% is not the same thing as it is for other assets. It's very volatile. But the bottom line is it's gone down since then. So there's that. I'm not sure if I'd say it's hanging out, but I would say that whatever is happening in Bitcoin is not what's happening in gold, and that's the important thing. There is not consistency. And so to me, what gold is maybe a kind of, there's almost a response that's almost geopolitical risk-like, in the sense that when markets are faced with things they have a hard time forecasting, they reflexively go to gold. Bombs start going off in Russia, Ukraine in 2022 when the conflict initially starts. What's one of the first things that happens? Gold surges. Why? What is it about gold that somehow is reactive to Russia trying to invade Ukraine? Nothing necessarily. It's not like the price of oil. It's not the price of wheat, things that might actually be disrupted by the fighting. It's not nat gas. Why gold? What is it about gold? There seems to be a kind of reflexive thing where if you don't know what to do, you go to gold. If you have no other ideas, if you look at the landscape and you go, I don't know what's going to happen here or what this means. And to the extent that even the dollar is a creature of yields, unless it's utter panic. We saw this obviously at the onset of COVID. We saw this in the 2008 crisis, where when people are selling things that just to go to cash, gold gets sold also. That's how you know it's not a haven. When people want to go to cash and just back up from markets completely, and it's correlation one liquidation, dollars and yen go up, bonds go up, everything else gets smashed. That's it. This is not where we are here, clearly. So my sense is that the reason gold is going up is just on general lack of forecastability grounds, or like a sense that forecastability is compromised the way it would be at the outbreak of a war. And so for lack of anything else to do, people are reflexively doing that.
In a weird way, I have a very similar model. Like when some uncertain thing happens, you see it in vol first, because that's just the pure measure of uncertainty. But because vol is sort of this mean reverting thing, uncertainty goes up. The market figures out what should I do with this uncertainty? Where should it be reflected in either a higher price of this asset or a lower price of that asset? Once that then gets priced out, vol comes back down. And so in a way, gold is a recipient sometimes of that level of uncertainty on those vol spikes, and that gets dampened out into gold. So I see it in a really similar way as you. Let me ask you this question. You've said so many things that have sort of spurred on, I think, interesting lines of thought and discussion here. Somebody in the chat talked about 1930s, and you've been talking about the uncertainty that comes with tariffs. I've sort of argued that I think the Smoot-Hawley, everyone going back to the 1930s as a one-to-one model with what will happen if you apply tariffs and protectionist policies, I'm not arguing that it's going to be more beneficial to a free market than free trade. That's not what I'm saying. What I am saying, though, is people are talking about you have basically a data set of one, right? You don't have a data set of 15 times in the past.
People love these stupid one-for-one comparisons. Correct. They're not representative of anything.
Correct. So what I think is in my personal opinion, it's very dangerous to go back and look at the Smoot-Hawley Tariff Act and look at what happened in the 1929, 1930 and how it exacerbated the Great Depression. I don't think.
I mean,
this
you
is
should go
good
back and
for-
look, but that doesn't mean anything necessarily.
I don't think it's good for global trade, but I think people should be really careful about creating an entire mental model that says this is what will happen if we move forward with this in the future. And I think that's a big mental trap out there for market participants. What do you think about that?
I don't know how much of a mental trap it is for market participants, just because I couldn't possibly presume to poll everyone or have a sense of even what this looks like. I do know that obviously, I mean, so clearly we do not live in the 1930s for so many reasons. I mean, the fiat-based monetary system, the nature of global trade interdependence, deglobalization or not, the nature of global markets, the U.S. place in the world, the situation happening in Europe. I mean, we'll be here until next week if I list everything. So, and then we'll do the show again. There's absolutely no logical reason to say this is the 1930s. None. What you do derive from an analysis of the 1930s are the mechanisms by which tariffs can be very damaging and what the vectors of transmission are. To then look at the current environment and say, okay, if this is how the machine works, or at least these are the knock-on relationships that we've seen, how would that scenario map onto the current environment? And what would that mean? You're not looking for parallels. You're looking to learn about how these forces have manifested before so that you can construct a probabilistic scenario analysis and say, well, this part is logical, this part isn't. Retaliation against the tariffs is logical. China, Japan, and Korea are talking about deepening trade relationships. When have these economies agreed on anything ever? So you look at what Canada is saying, and Canada is saying we will retaliate. You're looking at Europe. Europe is saying we will retaliate. Is it wise to retaliate? Maybe not. Does the retaliation mark something that the administration expects and is factored into their plans, or it isn't? Do they know it's coming because they too are students of history? Or do they expect that they'll be able to negotiate these things down? If everything is negotiable, are you ever going to get something that businesses like manufacturers that use the inputs that are going to be impacted by all of this are able to take and forecast forward? Or is this just going to be a perpetual moving target? And what does that do for confidence? I think really all you're doing in looking at hopefully what you're doing in looking at the 1930s is you're not looking for direct parallels or, God forbid, saying this is the 1930s, because that's just intellectually insane. But what you're doing is you're looking at the forces and saying, well, here's one way that this has gone before. What can I learn here?
What is everyone thinking? Where is a trade where everyone's leaning in one direction, either with their mental models or with their consensus positioning, that you think could go the other direction? My biggest thing is I actually think I'm very curious if slowdown in growth is going to be the boom for the long end of the curve in the way that people expect. I think this is, to me, it may turn out to be true, but I think there's enough risk and reward there that I think it's probably worth betting on, that as we get closer to June, and people want to buy the long end of the curve given the slowing growth in the marketplace, I think that's worth betting against. that I think the worse growth gets, people are going to recognize that, okay, we're laying people off, growth is slowing, uncertainty is high, and we're already running 6% deficits to GDP, which means you need to respond with services, with help, which means increase government spending, not the opposite. And I think if that is ultimately the realization of both the fiscal authorities and then ultimately the market, I don't think the long end is going to cooperate and there's going to be this recession bid in the long end as people expect. So that's what I think the consensus narrative is. I think that's the mental model. And I think there's a risk to reward favoring betting against that as we get to June. I might totally be wrong, and that's why that's why it's out of consensus, but I think it's worth betting against. Is there anything like that in the market that you see? What is it?
Gold. And I think it's actually
walk me through it.
It's actually for the same, there's sort of parallel reasons to what you're describing. I just think there's 1,000,001 ways that bonds could rally before all of the realizations that you're talking about are actually had. And so bonds have lots of runway to keep doing what they're doing before any of what you're describing actually enters the calculus. And then if it does, we'll see. But I'm perfectly happy to still be long in a market that is very clearly stair-stepping higher. Gold, on the other hand, as we've just said, seems not to be an animal of yield necessarily. Seems not to be an animal of the dollar necessarily, as it typically is. This has been different. Gold has more so taken on this kind of when in doubt and the bombs are falling and the fog of war has settled, well, at least you can still buy gold. That seems to be the sort of operating logic. And if everybody is afraid of uncertainty and gold is the ultimate manifestation, that basically the distribution is widening to an uncomfortable place, the most contrarian thing would be if the distribution were actually to narrow. And let's say you have a Liberation Day announcement tomorrow, and what it amounts to is a tariff policy bookend. Because if you look at the sort of political timeline here, you figure next year is all about running for the midterms and securing majorities in the houses to make sure the agenda keeps going forward. Obviously, we've already seen some concerns around making sure that goes right with the pulling of Elise Stefanik from the UN role, with all this money getting funneled into this judgeship race in Wisconsin. There's clearly now suddenly a sense like, look, we need to make sure that we maintain hold on the legislature. Otherwise, all of this is just smoke. So next year probably is spent running for the midterms. And like making sure that nobody is yelling at GOP congressmen at town halls and things like this, because that's not the recipe for success in the midterms, clearly. So if that's what it is, then you need to do the tax cuts in the second half of this year. Then you need to be done with esoteric bull in China shop policies basically by mid-year. So things like twisting the arm of Russia and Ukraine, twisting the arm of Israel and Hamas, and getting the trade policy architecture in place. Doing all of the let me scare you with how crazy I am. I'm a crazy guy. All of that is running out of time. And so maybe you call it Liberation Day, 72-point font, big L, and you go, boom, this is what it is. And then you stop picking at the scab. Well, then the markets get the thing that they wanted, which is a forecastable thing to price into markets. And they stopped to linger on every single headline in this conversation. Oh, Mexico called Trump. Trump called Canada. Canada called Mexico. Oh, all of that goes away. Stocks probably like that until they have to think about the growth implications of trade barriers more generally. And that ultimately catches up, and you ultimately get more stimulus and all of this. Stocks probably like it in the near term. Gold absolutely hates it.
I really like that concept. I really like that concept, even as just a short term, like the straddle on gold till the end of the week is $50.
Yeah.
And to me,
if what happens tomorrow is nobody pukes their lunch,
$150. That's a 3-to-1 potential.
If stocks don't puke going into the announcement tomorrow, and then they don't puke again the day after, because they decide they have certainty and that's what they were after all along, or at least enough certainty all along, the thing that bonds still go higher because you still need lower rates, but gold gets shellacked. And by the way, does so in a disconnected way as it's been behaving.
Man, I really like that trade. Let me ask you this question. Fed cuts once, inflation expectations rip. What happens then? Like, so right now the market has three
they're already
priced in.
Rising.
I know. So we got 3 cuts priced in, inflation expectations rising, the data was ugly. Yeah. Let's say they cut once, inflation expectations absolutely rip, gold goes vertical. What does the Fed do? Basically what I'm asking is, could we be in a position where you can price in 3 cuts for the year if you want to, but get one cut and see what the market does, especially if the long end lifts, inflation expectations rip, they're not going to be able to do anything for the rest of the year. Do you think that's a possibility? And what would the market, how would you express that view then?
So I think this is really where what Powell said after the meeting this month, I think this is what he's getting at. And God help him, he better get a thesaurus ahead of this speech on Friday so that he doesn't say words that he's not supposed to say. Get you a thesaurus, man. Seriously.
You don't think he should say transitory again?
Of all the 90 euphemisms you could have used for the concept you're trying to get across, which is actually a sensible thing and matches what the administration is saying, which is the tariffs are a one-time price adjustment.
Yep. I think that's what he was trying to communicate to everybody.
Of course. What he was trying to say is, look, we don't know. Maybe it's a one-time price adjustment, or maybe it isn't. We're guessing just as you're guessing.
Yes, but our base case is that it is going to be a one-time price adjustment.
Is that it is.
Yes,
that it is.
I 100% agree that that's what he was trying to say.
Right? He wasn't saying any. He was not making any reference to 2021 at all. But he had to use the word and get everybody in a kerfuffle and turn the conversation into something that it isn't. So man better get himself a thesaurus, is what I'm saying. So if he's right, if they're right, then it sort of goes like this. We don't know what the tariffs are going to do because nobody knows what the tariffs are going to do. In fact, the reasons markets are selling off is because they don't know what the plan is. And if they knew the plan, the markets wouldn't be selling off. They would just discount the plan into asset values and move on. But they don't feel like they have a thing to discount. They feel like it changes too frequently, and they want to discount something. Because let's face it, stock markets don't want to go down. Stock markets never want to go down. Stock markets are biased to going higher. They're one of the few markets with a tilt in the distribution. They're not a true two-way market. And so when you look at then what stocks want to do, they don't want to go down, but they are. So they're not getting what they want to get and begrudgingly are going down. They want to believe that everything is going to be okay. So what Powell is saying is, look it, we don't know, you don't know. Our base case is this. We'll see what it is. And we already had 2 cuts on the menu before any of this because inflation expectations need to be paced by adjusting to nominal rates, or real rates surge and then you crush the economy. So we were going to cut rates anyway because obviously the pace of inflation is down from 7 or 9, depending on whether you look at the peak in CPI or PCE. It's not down to 2, but it's obviously not 7 or 9. So clearly we need to adjust. That was that was coming anyway. And that's why what he's saying is, let us see all this survey data consternation in hard data. And then we will make the determination. If the cuts that we're making are still maintenance cuts, because inflation has come down, or if the cuts are counter-cyclical cuts, because the economy is falling off a cliff and we need to fire a fight. And the response ultimately becomes very different. So if the cuts are coming for bad reasons, if it's an anti-growth thing, then bonds go up across the board. The entire sort of structure of the curve is going to move. As the markets speculate that that's what the Fed will do. And once they start to do it, the markets will go, speculation has become reality now. Buy the rumor, sell the fact. We can go the other way as long as it's within consensus forecasts. And then you sort of get that dance. Markets expect this many cuts. The Fed expects that many. Where do they meet? And what's the speculative juice in that delta? Okay, fine. But if it's a different kind of cuts, then it's a different kind of story.
Yeah, I think you definitely answered my question, and because so my question is, if they cut in June and inflation expectations are rising, how is it possible that they could continue? What you're saying is it's going to depend on growth, and they can hide behind the growth story.
Inflation expectations are only rising if growth is positive as they cut, which means they're maintenance cuts.
No, I think what will happen is they're going to yes, but I think what's more likely is I do think inflation expectations are going to rise on that cut. But I think they're going to hide behind the tariffs, and they're going to say, because we think this is a one-time thing, like they that will give them license to stay with the same, they were
going to cut in June before the tariffs, before we even started.
I know, but it would be very difficult to do that if inflation expectations were rising in their face. So this gives them sort of the cover. The tariffs are going to give them the cover to keep going.
You're saying this gives them the cover to cut even if inflation expectations are rising.
Because the whole transitory thing, you can tell that narrative again if you blame the inflation expectation, if you blame that on tariffs and you say
we have to look through the inflation.
Exactly. And that's what he's giving everybody. Yeah. He's giving everybody that model to start looking through inflation data as it starts to rip when they start these cuts, and it already is. Arguably, that's why gold is where it is.
I mean, you can certainly make so again, yes, in a roundabout way, it depends why they're cutting. If they're cutting because they're saying 1 or 2 hot CPI numbers don't bother us,
correct. And we need to respond to growth conditions, yada yada yada.
That's one thing.
Yes.
Yes. If we see it in the and I think the counter argument to that thesis is they haven't cut yet, because they could have done this already. They could have laid the groundwork for this already. Powell is pointedly saying, until I see it in the hard data, I'm not doing it. And maybe that's coverage for the Fed in the sense that nobody's going to come back and say, oh, well, the president yelled at Powell, I want lower rates. Powell found a way. You see it in the hard data, and then if you do, then who is to argue you? Okay, fine. Maybe that's what's going on. And maybe ultimately they think, okay, this is something to look through, and they're going to do their cuts and use the tariffs as cover. Maybe. It's unclear why they would need to do that. They were going to cut anyway before the tariffs. They don't need cover. Do they? They had 50 basis points in the forecast in December.
Yeah.
So they were going to cut anyway. They don't need cover. So do they need cover for more? Okay, maybe. If they need cover for more, why? What has happened that they feel like they need more? Is it growth, or is it just they want to smooth over this bump here in sentiment and make sure sentiment doesn't careen and sort of negativity starts to beget negativity? Because so much of this is sentiment. Companies get freaked out. They stop spending. They stop spending. People don't get jobs. People don't get jobs. They stop spending. And it becomes a self-fulfilling kind of vicious cycle. Let's say the Fed is saying, you know what? The most important thing for us here, though we think the tariffs are not something that's going to be a lasting influence, is to keep sentiment underpinned so no one freaks out. So let's give everybody the sound bites that they need. And with the FOMC announcement, they kind of did that. Powell kind of commiserated with the markets, sort of took the markets by the shoulder and said, it's okay, man. You'll be all right. If things really hit the fan, I'm here for you. And it kind of worked. But it didn't last.
Markets can be this really sick mechanism to go find somebody's pain point. So if you remember when FTX was going through their whole deal and Carolyn, I think her name is Carolyn, comes out and says, we'll buy all of the whatever bullshit token at whatever price she said, like 23 or whatever, 22 and a half.
Give us Tether and give us Solana. We have no bottom.
The markets go, why'd she say that number? Let's see what happens if we push this button. So they take the collateral on that token to below the price, and turns out, that's what happens if we push this button. So markets have this really interesting way of finding, if we're playing chicken with the Fed, they're going to go find, okay, where's their line? Where's their limit? If we're playing chicken with the fiscal authorities, we're going to go find the limit. Where do you think, I'm going to ask you too, where do you think Donald Trump and the Trump administration's pain point for equities volatility, where do you think that is if you had to take a guess? And I'm going to ask you the same thing, maybe not equities for Powell, but tell me where you think his pain point is that the market could go scratch around. So two-part question.
I think one of the things that bulls have gotten wrong about this Trump administration versus the previous is that they've assumed that the administration has a pain point. And I don't think it does.
I think it's his approval rating. As long as his approval rating is high, I don't think it matters what ball does.
I don't even think it's the approval rating.
All right, talk to me.
I think it's bond yields. Because I think if you look at who the president's constituency is, it is people that are lower on the income scale on average. It is people who own less stock on average than the other side. Again, these are all relative things. But these are people who are much more sensitive to the cost of borrowing than they are to what the S&P 500 does. And so I think what this administration's sensitivity is inflation, and the cost of money. And if it's able to bring down inflation, and if it's able to bring down the cost of money, if the stock market has to die, figuratively speaking, of course. Nobody's saying it's going to zero. Nobody's saying we're going to have a 2008 type crisis. You can't know that here. I certainly can't. There's no evidence of it. And of course, if it does happen, all the kind of a broken clock is right twice a day types are going to come out and say, see, I told you. It's sort of like when Schiff tells you that gold is going to soar, and then he tells it to you for enough decades, and then for some of the time gold soars, and Peter Schiff goes, see? Yeah, okay. But when you look at the evidence, there's no evidence of an imminent collapse. What there is, perhaps, is evidence of the early stages of a recession of a classic kind of business cycle variety. Maybe. We'll see. To Powell's point, we'll see if it shows up in the hard data. I think it's already showing up there if you look at CPI internals, but we'll see. So I think this administration's pain point is not in the stock market, because they care much more about delivering for their core voters, and their core voters care much more about inflation and borrowing costs.
I get what you're saying theoretically, but I don't think it's literally true. Because
I mean, unless there's a panic. If there's a panic,
if the stock market was down
story.
30%, you have to understand.
No, if there's
what
a
would
panic
be happening that would create that. So
if
I get
there's
what
a
you're saying.
panic,
In theory,
that would be
for sure.
everybody's pain point, and that's my point. There is no panic here.
And
so
if you gave, and then conversely, if you gave, if we had super low yields, like if, let's say, borrowing costs cut in half, again, the way you would get there is through either super dumb, super crazy economic pain, which means there aren't a lot of people to enjoy. There aren't a lot of people employed to enjoy those low yields because we've just slashed all government spending and likely went through a deep recession. Or we did some financial wizardry in QE, which is somehow, holding down longer end yields a lot lower, which is probably bad for inflation. So I hear what you're saying in theory. I do think, though, there are limits to both of those. There's probably a limit to how low they want yields, and there's probably a limit to how low they want stocks. And so the question was, like, if the market as a sick pain-finding mechanism, the market believes, or I think there's a narrative that, okay, Bessent and that crew, they want to maintain lower borrowing costs for the U.S., and to your point, they want to do it through some sort of fiscal discipline so that inflation doesn't, for the working class.
I can tell you how you can find out you're at the pain point, though.
Well, how?
I'm going to borrow a Powell-ism, right? We don't know where the neutral rate is. We know it by its works. So you'll know.
Such a good line. It's such a good line. It's such a nonsense thing too. It's such a smart way to say I don't know. I don't know what's going on.
And no one knows, right? Like, it's such a smart way to say, like dumb journalist, your question is stupid. And if you knew anything about how monetary policy works, you wouldn't ask it.
Look, if you're going to pretend to be, I don't think they do. One of the people on this committee, I think in the eyes of the public, that's what it is. So you get a journalist there asking the question, how does this work? And
but that's not what they ask.
Everyone's talking about the neutral rate.
Where's the neutral rate?
Well, yeah, I mean,
nobody can know that.
I understand it, but I think from the general public's point of view. Okay, go ahead.
Yeah. No, but this is the point. No, so yes, from the general public's point of view, I'll spend like one more second on this, and then I promise I'll stop picking on reporters. But if you're trying to inform the general public, one way you would do that is by asking meaningful questions so that the public doesn't get misled down some sort of ridiculous rabbit hole, but that they actually understand. if you're a good
here's the recursive problem you get yourself into with their Looney Tunes world that they want us to live in, is that they'll say, we believe we're in restrictive territory. Okay, what's restrictive? It means that we have a Fed funds rate that's above the neutral rate. Okay, what's the neutral rate? Well, we don't know.
We know it by its
like
works.
This, yes, there's this
But this is the whole thing.
It is so fair for anybody to be rightly confused by how confident you are that you believe you're at some restrictive territory, but then in the same breath say, no one can know this number.
But it's a completely accurate way of describing things, because again, how do you know that you've reached market extreme, right? That the panic is here, that the pain point for everybody has arrived. If you are in an environment where stocks and gold are falling together, bonds are rising, and the dollar and yen are rising at the same time, so dollar up, yields down, stocks down, gold down. In other words, what's up is cash and near cash, and it's the dollar outperforming and the yen. You've reached a panic. And if you've reached a panic, nobody wants a panic. It's sort of like if you are if you are a Middle Ages witch doctor and you're trying to use bloodletting to improve your patient's well-being, and then you accidentally can't stop the bleeding. And you go, oh, I was in for a little bloodletting. I wasn't in for death. That would be the point where everybody would go, whoa, 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 whoa. This isn't bloodletting. This is bleeding out. That's different.
I would agree with that. I would agree when those conditions arrive, wherever that is, whether that's 5% lower, 10% lower, 30%
whatever it
lower.
Is.
Yeah, I would agree. That's probably a good way to describe it.
If people are selling stocks and gold and every currency and buying bonds and yen and dollar cash, and that's it, and everything else is getting shellacked, just look at a chart of the second half of 2008. You'll see it. Look at the first couple months of COVID. You'll see it. Clear as day. Move to cash. Move to say, I'm not participating in these markets. I will see you later. I am not going to look for relative risk opportunities. I'm not going to look for relative anything or risk anything. I'm going to put this money in the mattress. Have a nice day. When you see that.
The older I get, the more I
panic.
realize. Don't you think that's net? Like that's always the sucker's bet.
No, because if you thought that was the sucker's bet when Lehman collapsed, you're the sucker. If you thought that was the sucker's bet when COVID initially appeared in late 2019, you're the sucker. The question is, do you think that's going to lead to the end of human civilization? That's a sucker's bet.
No, what I'm saying is when that deflationary impulse comes, you know you're at the bottom. You don't know how far.
You don't know where that is, though.
But you do know. I know. I'm saying that you're really close to the fiscal and monetary impulse that ultimately is going to come.
But sometimes that can take months.
When that condition occurs, you're literally the market's finding it's going to go find that pain point.
Yes.
We are in pain point seeking mode in that moment.
But
so my question to you isn't
can
you make money? It isn't can you make money by being long dollars in that scenario? Of course you can. But my point is, if you fall in love with that position, the idea of going cash and not deploying money in that moment when there's max fear and the market is trying to find the pain point to get the fiscal and monetary response.
Well, then yes, you are a sucker.
Yeah, that's the sucker's bet.
Yes. Yeah. You cannot over extrapolate on negativity. Mm-hmm. Because there will be a policy response. The trouble is you never know when that is.
That's right.
And so if you think, oh, it doesn't matter, eventually the Fed will come and rescue me, good luck piecing your head back together, because the market will run through you. But if you think that the Fed will never come to the rescue and everything is doomed and we will never have sunshine ever again, well, then you haven't been paying attention. And so what you're looking for is you're looking for the Fed, much as it did in the beginning of COVID, to come out and basically look into the camera and go, no, this will not stand. You will have all the free money that you need. Stop it. The moment that happens, the panic is broken.
Mm-hmm.
And you saw this in dribs and drabs as a test case during the 08 crisis, where we had QE1, then we stopped, then QE2, then we stopped. We figured out how to announce QE. Oh, we're going to do this much QE. We're going to do that much QE. Okay, now we're going to twist the maturities a little bit. So it's not more QE, it's different QE. We're going to shift the papers from pile A to pile B now. Okay, now, no, that didn't work. Now more QE. What they learned there was just do all the QE open-ended and do it all up front, because the whole thing is a sentiment game much more than it is an actual easing game. You need markets to unclench. And the Fed learned that, which is why the QE in 2020 was so much smaller. The Fed came out and said from March to August, that was all of QE. That's it. Because all they had to do was come out front and say, we don't need to elongate this thing for years. Open-ended. If markets need liquidity, we got it. That's it.
Let me.
Market panic broke right there.
Let's do this. I thoroughly enjoyed this conversation. We are running up on time, Ilya. But if you could, I know you don't like to make super short-term sort of, nobody likes to make super short-term guesses on which direction things are going to go. But I'm going to ask you to do it. From now until the next time we talk, or basically to the end of this week, given that tomorrow's going to be an interesting day. Yes. Not only do you have a few items on the economic calendar, but obviously we're going to have some stuff coming from the Rose Garden.
Yes.
Would you rather be leaning long equity risk from now to the end of the week? Would you rather be leaning long or short equity risk from now to the end of the week, given where we are in the range?
Short. In fact, I am short. I have put verticals in SPY and in the Qs.
Would you rather be leaning long or short ZB, so the long end of the curve? TLT, I suppose, works too.
Long, and I have TLT verticals on that I bought around where ZB was sort of in the upper 115s, low 116s range. So it initially got into that range. I bought, then it pulled back after an initial rally. I bought some more.
Gold, would you rather be long or short into the end of the week?
Short.
And the dollar as a basket against other currencies, long or short?
I have a divergent exposure to the dollar. I'm long the euro, and in general, I think European currencies outperform. I'm short the Aussie. I think anything growth related is going to underperform.
My man, I really enjoyed this conversation. Ilya Spivak, the people want more from you, and they want to, it's going to be a wild week. I think people should be listening to you as you sum up at the end of the day what happened from a data perspective, but also some of the geopolitics. Can you tell them where they can go to get more Ilya Spivak?
Absolutely. So I am on at the market close on tastylive every day. So we do overtime right at the close after last call with myself and Chris and Dylan Radigan. Then Macro Money follows, where I unpick sort of the macro relevant topic of the day. And I try to be forward looking, by the way. I try not to talk about what's already happened, but to forecast forward. on each one of those shows. So they're always going to aim toward tradability and actionability. I don't want to talk about what CNN or Bloomberg or CNBC has already covered. I want to talk about what's going to happen next. So those shows are always forward-minded. Obviously, we're here on Tuesdays every week. We also talk to Tom on Sundays every week for First Call at the futures market open, or APAC market open, as you wish. I'm also writing for the news and insights area of tastylive.com, and I'm commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky.
My man, if I had to bet, I think this is the way I'm betting. I think at the end of the week, we're probably somewhere close to where we are now. But I think we got to get people chasing. So my guess is some catalyst, whether it's tomorrow or the next day, gets them running towards 5,800. Yeah. I think people go, oh my God, I missed it. They start buying. We chase really quick up a couple of percent in a day or so. And I think towards the end of the week, we get some soft economic data, and we probably undo a lot of that optimism. And I think we probably end the week somewhere close to where we are now. But in the middle between now and then, you get a narrative that over-rotates to, oh my God, it wasn't so bad, back to, oh my God, we didn't add any jobs in the economy. I think it'll go crazy upside, and then 2 days later we'll be back.
It's either that. So it's either that or, oh my God, this is the worst tariff policy ever. But then the jobs numbers come out good, and Powell is like, what are you worried about? And people go, and then
maybe, but I think
we end up kind
that
of
scenario is harder, because if you break this floor, so if what you're saying is true and you break the 5,500 floor, the problem is now you've got technical sellers. Now you have this technical flow that comes in and puts pressure on any positive narrative, which becomes harder to I think, get back to 55. My man, I really enjoyed the conversation, bro. Always a pleasure. Good luck with Liberation tomorrow. Godspeed. For all of you, hit the like button on your way out of here. You can follow me on Twitter if you want, at Victor Jones, at Owen Jones is here, because I like to be difficult. We'll see you back here, same time, same place, same great network, with a conversation with Chris Vecchio tomorrow. Until then, peace.
Peace.